Hi, and thank you for joining us today for our virtual gold conference. With inflation at 40-year highs, the U.S. Fed has declared war on inflation and has lifted interest rates 5 times since March. The U.S. dollar is up 15% against all major currencies, and this has put a lot of pressure on gold and gold equities. But many gold companies have little or no debt, are cash flowing, and are returning cash to shareholders in the form of dividends and buybacks. And this has created an amazing opportunity for investors. So we brought together some amazing expert speakers and some of the best producers and developers to provide you with some actionable ideas. Our expert speakers include John Reade from the World Gold Council, Joe Lunn from Jupiter Asset Management, Ronnie Stoferle from Incrementum. Our presenting companies include John McCluskey from Alamos Gold, Rodrigo Barbosa from Aurora Minerals, George Burns from Eldorado Gold, Greg Lang from Novagold, Jose Vizquerra from O3 Mining, Simon Jessop from Northern Star Resources, David Smith from Agnico Eagle, and we have to thank our corporate sponsor, Sprott Money, the most trusted name in precious metals. Now, there's one more thing I have to ask you to do. That is subscribe to our channel, Bloor Street Capital. Give us a like and leave a comment. I hope you enjoy the conference. Hi, John. Thank you very much for joining us today. How are things in London?
Well, we have had some fairly interesting developments on the political and economic front in the last few weeks. So I think it's probably fair to say it's volatile in London at the moment, both in terms of the currency, in terms of equity markets, and particularly in terms of government bonds.
And we're going to have a discussion on all of these events. So 2022, as you just alluded to, has been a brutal year for financial markets, and gold hasn't gone unscathed. Central banks started lifting interest rates in March, and they've acted rather aggressively since this time, and this has put a lot of pressure on gold, and I want to have a detailed discussion on this. But before we do that, why don't you just provide us with a brief overview of the World Gold Council? What is its mandate? And maybe you can also speak to the membership.
Sure. So we're a membership organization, as you alluded to, owned by some of the leading gold mining companies in the world. I think we've got about 31 members. It's difficult to keep count because they keep merging and buying each other. But it's all the names that you'd know from Canada, Australia, South Africa, and various other countries around the world. And we were set up about 35 years ago now to develop the gold market. So we're a market development association, really, for the gold market. And initially, we concentrated on jewelry demand because that was the biggest contributor to demand back then. And we've shifted slowly and then quite rapidly, I guess, over the last 10 years to be very much focused on investment. So we try and make gold more accessible to investors all around the world. And we do that in a number of ways. One thing that we believe is that for people to make investments in gold, they've got to have statistics and research reports and tools to analyze gold. Because if they don't have any of those things, then, well, how do you approach it? It's not like an equity or a bond. It is a different instrument. So I have a big research team that I work with at the World Gold Council. We produce lots of research, both on the fundamentals of supply and demand, but also on the investment drivers of gold as well. I say we have a very good website, which all of this information is available for free. We collect gold market data and make that available for free as well, particularly on the supply and demand side, but not only that. And then we also get involved in other things as well. ESG has become a big focus of ours because of the necessity of being able to talk about the ESG credentials of gold when you go and speak to certain investors. Similarly, we have a big focus on central banks. There's a team at the World Gold Council that exclusively talks to central banks, and we speak to about 94% of them, and the only ones we don't are sanctions, usually. And then we work sometimes with governments or regulators to try and open up the gold market, where there might be restrictions or unfair taxes on gold investment. We'll work to try and break those barriers down. And where necessary, we'll help develop infrastructure. So we're just completing a project now to get gold exchanges into India, which is a big part of modernizing the gold market that's going on at the moment. So we do lots of things. I'm primarily focused on the research and working very closely with our institutional relationship managers, so speaking to investors around the world and making the case why they should have gold in their portfolio.
John, I want to move on now and discuss the gold price and also the performance year to date. Gold started the year at $1,800 and it was up 10% on the year, but that all changed in the month of March when the Federal Reserve started increasing interest rates for the first time in 3 years, I might add, and they've raised a total of 5 times since then. The US dollar index is up 15% on the year. Gold is down approximately 8% on the year. This is much better than the S&P, which is down over 20% on the year. But I want to get a sense from you of what this move in interest rates and also the US dollar has done to gold flows, I guess, both in bullion and investments and also ETFs.
Sure. I mean, I think the way you described it in that question is very valid. Gold down about 8%, US dollar index up about 15%. So I just come back from marketing in Germany, attending a precious metals conference there run by one of the big refineries. And as I pointed out to them, yes, gold's down in dollar terms, but it's up in euro terms, it's up in yen terms, it's up a lot in sterling terms, and certain other currencies as well. So the biggest factor in the gold market this year, certainly in terms of determining the US dollar price, has been this remarkable strength of the US dollar. Now, the US isn't the only country to be hiking interest rates, but as I was describing to this bunch of German investors and fabricators, what's happening in the US is quite different from the other markets. The US is hiking rates because its economy is strong, and that strength in the economy is leading to inflation and very low unemployment, and the Federal Reserve has decided it needs to slow the economy down to get inflation under control. Fine, that sounds like a normal recession to me. When the Fed kills every recovery by hiking interest rates. Great. But what's happening in the rest of the world is quite different. If you look at Europe, yes, rates have started to go up there, but they're not going up because the economy is strong. They're going up because inflation is high, and inflation is mostly high because of factors outside of the domestic economy's control. So we're talking about energy prices in Europe. We're talking about weakness in the global economy that's coming from, say, China and the real estate market there, which looks quite troubled at the moment. So this difference, the bifurcation really in the global economy, the US is strong, everywhere else is weak, and the US has been more enthusiastic in hiking interest rates than anybody else, has caused this remarkable strength of the US dollar. It's been a clear headwind for gold. Now, interest rate hikes also or hikes by the Fed, I should say, have been a factor too. But I think the biggest factor here is the impact that we're seeing on the US dollar. And that headwind looks set to continue, I think, for as long as the Fed is the most aggressive central bank on the planet, and for as long as it keeps increasing its forecasts of inflation, and of course its own central bank rates as well, the so-called dot plot. Now, that doesn't mean that the headwinds in gold will necessarily continue. I mean, I think even a hiking Fed is no bad thing, but it's just whilst they're ratcheting up their forecasts of inflation and interest rates, that's causing a headwind for gold, mainly through the channel of the US dollar.
So I understand the argument for gold being under pressure because of interest rates in the US dollar, but we've always heard that gold is something you own during times of trouble and during times of inflation. And with everything that's happening in the world with the war in Russia and the Ukraine, inflation at 40-year highs, why isn't gold doing better in this environment in spite of interest rates?
Sure. I'll rephrase that question in a slightly different way. When I speak to people that have followed the gold market and very closely over the last few decades, the question they come to me is, I said, why is gold holding up so well? If you look at a simple econometric model looking at the dollar and real US interest rates, which works generally very well in terms of explaining the moves in the gold price, then you would expect gold to be a lot lower than it has been. Now, to a certain extent, part of that was the Ukrainian war, or the Russian invasion of Ukraine, which did see gold strong in the first quarter. But I think most of that premium's probably come out of it now. I'm not saying the war's gone away, but it doesn't seem to be a shock to the market. Now you wake up every morning and you see what's happening overnight. It's not fresh news. So that's one factor. We did see decent investor and speculative activity as well around that time of the Russian invasion. We saw inflows into the ETFs at the start of this year. They have now reversed, and we're seeing not rapid but steady outflows, particularly from North American ETFs. Again, when I was speaking at the German conference this week, I showed them a chart of the holdings of German ETFs, which have grown over the last decade to become quite important, and they actually haven't fallen this year. It's very much demonstrating that it's a US investor reaction to the weakness that they're seeing in the price of gold in US dollar terms, and expectations for further strength and further dollar strength and further hikes in interest rates. So, gold has done well under the circumstances. Now, in terms of inflation, there's no doubt inflation's at 40-year record highs, I think, in most countries, and certainly around 10% in the UK, and quite close to that in the States, I believe. Work we've done and published a couple of years ago shows that gold isn't a great hedge of US CPI. What it's a much better hedge of is expansion in US M2 money supply. And if you look what happened to M2 back in 2020, when central banks around the world, and particularly the Fed, were carrying out extraordinary measures to protect economies, we saw a huge jump in the money supply, and obviously gold performed really well that year, up 25%. That monetary expansion has slowed dramatically, and together with quantitative tightening, you could argue that actually the amount of money sloshing around the US system is declining rather than increasing at the moment. So I think that's also one of the reasons why gold hasn't performed brilliantly in US dollars this year.
The last time we met, a lot of our discussion was focused on the outperformance of Bitcoin versus gold. And now that Bitcoin is down over 50% on the year, has this helped gold flows at all?
That's an interesting question. It certainly hasn't triggered any noticeable inflows into gold. As I say, you can characterize certainly the last 4 or 5 months of steady outflows from the exchange traded funds and reduced net long positions on the COMEX futures market in New York. In fact, they're running net short at the moment. So no, we can't identify any inflows into gold as a consequence of the weakness in Bitcoin. But then again, we were never able to identify any outflows in gold when Bitcoin was strong. Our experience is that investors understand that these are two very different instruments. And despite marketing from some of the crypto community, all the work we've done has demonstrated that having gold in a portfolio and having Bitcoin in a portfolio ends up doing two very different things. And one is not a substitute for the other. Now, I don't have any formal views on crypto assets. I'm with the World Gold Council. Why would you listen to me when I'm talking about crypto? So I'm not telling people to buy it or not buy it. But what I am saying is just understand what it does to your portfolio. If you own crypto assets, you've added risk to your portfolio. And one of the things that I would say under those circumstances is the best diversifier of that additional risk is to add some more gold to your portfolio as well. Now, we've done a lot of consumer research on this topic. Investors do recognize the difference from what we can see of what you should expect from having gold and what you might expect from having crypto assets. So I don't think they actually compete for each other in flow terms.
You mentioned earlier you were at a conference in Germany. You're all going on the road in the next few weeks, visiting other countries, other conferences. Maybe you can just touch on the feedback that you've gotten from investors at these conferences. And I'm sure you take a lot of calls too from investors, institutional investors, retail investors. Maybe you can just give us a sense of what people are saying.
Well, there's a number of things. The question about why hasn't gold done better is one that comes up a lot. I mean, it's outperformed equities, it's outperformed bonds, and it's gone up in non-US dollar terms, but everybody looks at the gold price in US dollars first and foremost. So I do get that question a lot. I spend a lot of time explaining what's been driving it and what you really should expect from gold under the current circumstances. But aside from, shall we say, the short-term direction of gold, we're getting a lot of inquiries from institutional investors and advisors about strategic allocations for gold. These are institutions or organizations that we've been speaking to for a number of years, and the conversation is a long one because we're talking about making a long-term investment at a strategic level. And I've been really pleasantly surprised by how those conversations have continued this year, despite the fact that dollar gold price is down. Look, we're nowhere near at a position yet where every institutional investor or every advisor is recommending an allocation to gold, but the direction of travel has been really encouraging this year. And I think that's only going to continue. So, I mean, I've visited the United States, Australia, Singapore, India, and as I said, Germany, all in the past 6 weeks. And I'm actually off to New York again tomorrow. Sunday. And we're having a lot of really interesting conversations. And I think that we're making the case aggressively and enthusiastically why gold should be in your portfolio. And I think this is having an impact in terms of demand, potentially for demand that we're not able to track necessarily if it's going through the over-the-counter market. And I think the long-term impact of this will be manifest.
John, as we wrap up, you've already touched on a lot of the benefits of holding gold, but maybe you can just summarize for our viewers why they should own gold in their investment portfolios. What are the benefits to holding gold?
I mean, it's a very simple argument, and I give this around the world, you know, in different currencies and compared to different local assets, and the story is always the same. People think gold is an asset that does well during crises or coronavirus pandemics or unexpected geopolitical tensions, and that's correct, it usually does, but it's more than that. Now, since 1971, or over the last 20 years, or over the last 10 and 5 years, it's delivered returns that have been in line with or better than most other asset classes. So it's a source of returns, not just for the bad times, but for all the times. And the second thing is diversification. I think most people know that gold helps diversify your portfolio because it's not correlated particularly to equities or other things with equity-like risk return. But what we find is if you look at what happens to gold's correlation to equities, it does move around. So when equities are rising rapidly, gold's modestly positively correlated to equities, which is obviously positive. When gold falls sharply, though, that correlation falls away and in some cases flips negative, so that you can now be either uncorrelated or even negatively correlated to a rapidly declining gold market. So that's diversification that really works well when you need it the most. So if you look at the performance of gold during crises and financial events over the last 20, 30 years, gold's generally done well during those periods when other assets are doing poorly. So you put those factors together, returns, diversification that works, particularly when you really need it, and some protection to your portfolio from black swan events or however you want to describe them, and having an appropriate weighting for gold increases your risk-adjusted return of your portfolio, kind of the holy grail for portfolio investing. Now, the final thing, what's the right amount of gold in your portfolio? There is no one single answer to that because it depends what's in the rest of your portfolio, depends what country you're in, depends what time period you're examining it over. But what we generally find is that for every portfolio we look at, pretty much all of the optimum allocations to gold come in between 4% and 10%. And generally speaking, the more equity risk or equity-like risk you have in your portfolio, the higher the target allocation to gold. The more fixed income you have in your portfolio, the lower target allocation to gold, because gold's a better diversifier of equity risk than it is of fixed income risk. That really, in summary, is what we say to investors. That's the strategic case for gold.
Well, John, that was a great overview of the World Gold Council and also the benefits of holding gold. And I want to thank you for sharing your thoughts with us today. I would encourage all of our viewers to check out the World Gold Council's website, gold.org. It has a wealth of information on there pertaining to anything and everything to do with gold. John, once again, thank you.
Thank you very much.
Hi, John. Thank you very much for joining us today. How are things in Toronto?
Wonderful. Pleasure to be here.
John, Alamos Gold has had many achievements this year, including moving forward with the Phase 3 expansion at Island Gold. And I want to examine that expansion in details and what it means for Alamos. But before we do that, why don't we just start with a brief overview of Alamos Gold for those viewers who might not be familiar with the company, just touching on how many producing mines you have and what your annual production is.
So Alamos produces from 3 mines, 2 located in Canada, the Young-Davidson mine and the Island Gold mine, and a third, the Mulatos mine, which is located in Sonora State, Mexico. Collectively, those mines are producing 460,000 ounces for 2022 at all-in sustaining costs of $1,200 an ounce. But when you factor in our growth, which incorporates the Island Gold Phase 3 expansion and the addition of our Lunn Lake project in northern Manitoba, that will take our production up to 800,000 ounces a year by 2028, and our costs will be roughly $1,000 all-in sustaining cost. So that is sort of where we are and effectively where we're headed.
And John, before we dive into your various operations, Alamos Gold has been a rather strong performer, no performer in a rather challenging year. Maybe you could just touch on why that is.
I think it's a combination of things as usual, but primarily we've had some very interesting developments over the course of 2022. In spring, of course, we announced the Phase 3 study, which was very well received by the market. I think the capital cost is about right. The return on investment is very strong, and the fact that we've turned what looked like a relatively small insignificant asset when we acquired it, we've turned it into a really first class operation, and the Phase 3 study envisions it becoming one of the best gold mines in the world. It'll be able to produce 285 to 300,000 ounces a year for 17 years at cash costs under $600 all-in sustaining costs. So that's a remarkably productive, remarkably profitable mine. We also had a big challenge in that we started construction on our La Yaqui Grande deposit. It's part of the Mulatos complex in Mexico. And we only started production on that, construction on that operation after COVID had hit. So it was sort of spring of 20. And it's very challenging under any circumstance to build a gold mine, but to build one with the backdrop of a pandemic and so forth. And of course, inflation started to creep in towards the latter end of the construction. So there was every opportunity for things to go wrong, let's put it that way. But in fact, we built the mine on time and on budget. It started producing in June of this year. It's going to be a great operation for us, really transformational for what's going on down at Mulatos. The fact that that came in so successfully, I think, was very encouraging for the market. So those were probably the 2 most significant catalysts in terms of putting us in a position to outperform this year.
John, I want to move on now and discuss your operations in more detail. A primary driver to future growth at Alamos is the Phase 3 expansion at Island Gold. And once complete, it will effectively double your production at Island Gold. Can you just provide a brief overview of Island Gold operation and how things are progressing with the expansion?
Indeed. First and foremost, this has been driven by exploration, and we've just had tremendous success on that front. When we initially looked at a Phase 3 expansion, we were sitting with roughly 3.7 million ounces of gold. And a year later, a little more than a year later, we were sitting with 5.1 million ounces of gold, and that was net of depletion. We've mined about 600,000 ounces or so from Island Gold since 2017. So net of that depletion, there's been a pretty substantial expansion. And as we've expanded it, the grade has been increasing. And the most recent blocks that we defined last year, we had over 1 million ounces come in at 15.5 grams. the lower east portion of the mine. That's an extraordinary development for us, and that gave us the wherewithal to take a second look at the expansion and see if we couldn't make it a little better than what we originally envisioned, which was a 2,000 ton per day operation producing around 240,000 ounces a year. So we bumped it up a little more, and with those good grades, a little bump in throughput brings a lot of additional production. So going from 2,000 to 2,400 tons a day essentially pushed the mine up to 285,000 ounces a year. Of course, there'll be quite a few years where we actually hit 300,000 ounces with the higher grades. So that's just in anybody's estimation. That's a world-class deposit, especially given the fact that it has a 17-year production horizon based on what we know today, and we fully expect it's going to grow quite a bit bigger yet. So, you know, you have to give credit to the exploration side of the company, and that's where things start. Going forward, though, the fact that we can look forward to a substantial portion of the company's production coming in at under $600 all-in sustaining costs, that's going to be a big boost for us. It's going to turn us into literally one of the lowest cost producers in the space, and the fact that that low cost production is coming out of Canada, I think that gives Canadians a lot of pride. I frankly think it gives our investors a lot of comfort, knowing that we've got this very secure, long life, low cost production coming out of Island Gold. As good as Young-Davidson is and will continue to be, it will ultimately be eclipsed by Island Gold. Island Gold is a very valuable asset. It's going to be the 7th largest gold mine in Canada with respect to production. It's going to be one of the lowest cost, if not the lowest cost mine, and ultimately one of the most profitable gold mines in the world.
That's a great overview of Island Gold. Let's move on now. Your second mine, which is also based in Ontario, Canada, is the Young-Davidson mine. It has a very storied history. Can you just provide a brief overview of the Young-Davidson mine, once again touching on annual production and your all-in sustaining cost?
You know, that mine is a little bit of an unsung hero because it did produce from the 1930s to the late 1950s, and it was one of the few examples of bulk underground mining anywhere in the world during those years of operation. It's never been a high-grade mine, but it's always benefited from the fact that the stopes were very large, and you were able to essentially skate on side with economies of scale. But for this era of its operation, we've taken it up well beyond anything that it ever saw in the past. So when we acquired it, we completed a merger of equals between ourselves and Agnico Gold at the time. It was operating at roughly 3,800 tons a day, and it was operating from the mid-level of the mine. So what remained to be done was that all the lower mine development and the installation of the permanent infrastructure at the 1,500 meter level, and we had to sink the shaft, both the primary shaft, which we call the Northgate shaft, and the secondary shaft called the MCM shaft. They both had to be pushed down from roughly 750 meters all the way down to the 1,500 meter level. So that was a tall task in front of us, and we managed to complete everything by 2020. And since that time, the mine has been operating at 8,000 tons a day. So now we really have the economies of scale working in our favor. And the reason why we can operate a gold mine at 8,000 tons a day is because the stopes are just enormous. I mean, a typical high-grade stope would be something like the size of a big bank's boardroom, something like that. The stopes at the Young-Davidson mine are about the height of a 12-story building, and they're about 25 meters wide and 50 meters deep. These stopes are enormous. So this allows us to mine the deposit at such a high rate, and given that throughput, we can make the most out of 2.4 grams. And as it is last year, Young-Davidson yielded over 100 million in free cash flow. And that's what it's capable of doing. It has basically a 14-year reserve, and with reserves and resources, we can see our way for producing for another 20 years. And I'm pretty confident it's going to go well beyond that. We've been doing further drilling, testing the future expansion of the mine, and clearly it's well mineralized, quite a bit below the current levels. So that's going to be a very profitable mine for the company, and very interesting. Long after virtually all the executives that run the company today, long after they're retired, it's still going to be a profitable mine. So,
John, your third producing mine, which was also your first producing mine at Alamos, is the Mulatos mine, which is located in Mexico. Can you talk a little bit about Mulatos and also how the ramp up is going at La Yaqui Grande?
well, that's we refer to Mulatos as Mulatos all the time, but in fact, Mulatos has been a whole series of mines, some of which were call it gently outlined by placer domes. So we had to sort of follow a paint by numbers kit to delineate reserves outside of the main Mulatos pit. And we were successful in doing so. We initially started that mine in 2005 with a 7-year production horizon. The main pit, 16 years later, is still producing. In addition to that, though, we've developed and mined out pits at San Carlos area, the El Victor area, the Cerro Pelon area, the first La Yaqui, and now we found grassroots discovery. We found La Yaqui Grande, and we permitted it and built it over the last couple of years, and now it's in production, and it's got about a 5-year horizon out in front of it. Over and above that, over the last year, we've been delineating a high grade ore body. Remarkably, it's located just adjacent to the main Mulatos pit. Who would have ever known? It was just sitting a little deeper than the open pit reserves that we've been producing from. But so far, we've delineated about 500,000 ounces, grading around 5.5 grams. We continue to drill it, and it continues to get bigger. So it looks like we've got another follow-up act once we've mined out La Yaqui Grande, and it looks like we're going to keep Mulatos producing for a long time to come. It's certainly been, the gift that kept on giving. Long after people sort of wrote that mine off, it continued to produce and profitably produce. And we used that profit to effectively turn ourselves into a mid-tier company by going out and acquiring other mines and ultimately developing them and turning them into the new flagships for the company going forward. But again, it's very satisfying to look at the Mulatos operation sort of 16 years after we commenced production, and it still has a long life ahead of it.
And John, just to clarify, construction at La Yaqui Grande was completed in June, and from now until the end of the year, and I guess going into 2023, you're just going to continue to ramp up. When will you become or go into full production?
Well, it's a relatively rapid ramp up for a mine like that. It's in terms of the mining, the crushing, stacking, that goes very quickly. It's just a question of getting enough of your crushed material under leach to start yielding the ounces of production that we would recognize as being steady state. It's going to produce roughly 30 to 35,000 ounces a quarter, in that range. And we should be sort of running at that rate by first quarter of next year. But it's producing as we speak, and we'll just, as time goes on and more of the stacked ore gets under leach, we'll just see more and more of the ounces coming out. The grade it's amazing. I mean, right now we're mining something like 0.7 to 0.8 gram ton material out of the main Mulatos pit. La Yaqui Grande, which is sitting right at surface, so virtually no strip, very short hauls, dead easy to crush. It's all oxidized, so very fast and very high recovery rates, and it's grading 1.2 grams. So it's pretty much one of the most profitable heap leaches operating anywhere right now.
And John, maybe you can just tell us what the all-in sustaining costs will be at La Yaqui Grande.
So when we're finished ramping up, which we'll achieve by the first quarter of next year, all-in sustaining costs should be under $600 an ounce.
So John, you do have a lot going on at Island Gold with the Island Gold expansion and also at Mulatos. Why don't we discuss your balance sheet now and just determine your liquidity? How much cash do you have on hand, and how will you allocate the cash in this coming year?
Well, we have about 130 million US in cash on the balance sheet. We have roughly another 50 million or so in marketable securities. We're debt free. We don't have any debt at all. We're producing a pretty significant cash flow from operations. So even with the money we're putting into the Island Gold expansion, which will roughly be in the range of about 160 million to 175 million dollars a year for the next few years, we can essentially pay for that out of the cash flow that we generate from operations. In fact, most of that will come from that cash flow from Canadian operations. So the balance sheet's very healthy, and it's going to remain so. In fact, we will generate free cash flow over and above the money the capital that we're putting into Island Gold expansion. Will generate free cash flow next year, and it'll even be bigger the year after. So I don't see any risk to our very healthy balance sheet. And over and above that, we do have a credit facility of 500 million, which is sitting completely unallocated. So we're very healthy.
John, one of the interesting elements of Alamos Gold is your M&A strategy. In 2015, you completed an MOE with Agnico Gold valued at $1.5 billion, through which you acquired the Young-Davidson mine. And then in 2017, you acquired Island Gold for $600 million, both of which were acquired at very challenging times in the cycle. And I guess you could argue we're in one of those times right now. Is this at a point, are we at a point in the cycle right now where you would consider acquiring other assets?
As much as I see attractive opportunities out there at the moment, we're not pursuing anything new for the time being. We figure with the work that we're doing on Island Gold, which is going to take a fair amount of capital from us between now and 2025, it seems like a more prudent approach to stay focused on our growth projects. Unlike 2015 and 2017, you referenced the deals we did to acquire both the Young-Davidson mine and the Island Gold mines. We only had one operating mine when we did those transactions. We were highly motivated to add new assets and to grow. But now with 3 operating mines, we already have the Lynn Lake project, which that's going to be a substantial producer for us as well. That's another Canadian producing asset that we'll have. That gives us some additional growth over and above what we have at the Island Gold project. So I don't think we're under the same pressure, and we're certainly not feeling the same sense of motivation to go out there and do deals as we did in past years. We've got a lot more on the go now. Having said all that, I'm a value player, and I've always been known as a value player. So if a very, very compelling opportunity comes our way, and it's on terms that are just too hard to resist, I suppose there's always that possibility. I never want to entirely rule it out. I just think that's really bad juju if you talk that way, because you always want to have the open-mindedness to take advantage of a good deal if it happens to come your way. But all things being equal, if nothing does fall in our lap like that, I'm quite happy with our current rate of growth, quite happy with the capital that we're spending and what it's going to yield from Island Gold. So not feeling any pressure at all.
John, as we discussed earlier, we've been going through a very challenging time this year, especially when it comes to inflation. And you've been one of the few producers that have not raised your cost guidance. And I'm just curious how you and your team have accomplished this.
So we have been seeing inflation just like the rest of the industry, but so far it hasn't had a significant impact on us. And there's a number of reasons for that. We've seen costs for consumables, so cyanide, grinding media, and so on. But they tend to be a smaller component of our overall cost structure. We have lower exposure to diesel costs, which represents about 7% of our cost, but we have much of that hedged anyway. 2/3 of our underground production is connected to grid power, so that's been relatively stable. And we also have longer-term contracts in place that have allowed us to keep our costs stable this year. We've also been helped by the weaker Canadian dollar, which is down from roughly 80 cents late last year. It's currently trading around 72, 73 cents. So all of these factors have weighed in to have us keep our cost guidance, our costs relatively flat, and that's how we've maintained stable cost guidance. Another contributing factor is the fact that we commenced production at La Yaqui Grande in June of this year. It's quite a bit lower cost than our main Mulatos pit, and this is going to be a significant contribution to lower costs coming out of our Mexican operations.
John, as we wrap up, what can investors expect in terms of news flow in the coming months and years from Alamos Gold?
Wow, there's one thing to talk about the coming months, quite another to talk about the coming years. But in terms of the balance of 2022, we're going to have a very strong finish to the year. We're going to see better production in Q3 and Q4 than we saw, let's say, in Q1 and Q2. That's holding together very, very well, and that's practically because in Q1 and Q2 we didn't have La Yaqui Grande yet. Now La Yaqui Grande is ramping up. It's adding a lot more low-cost ounces to our production profile. We intend to continue to do very well at Island Gold and Young-Davidson, and so on balance, we should see, better than a 10% jump in our production in the third quarter, and probably more like 15% jump in our production in the fourth quarter. So that'll give us a very strong finish in the near term. Beyond that, I would like to think you're going to see us continue to execute as we've always done on our construction projects. We've built quite a number of mines since I've been running the company. It was initially the Estrella pit of the Mulatos mine. It was a small portion of what became the big Mulatos pit, which is about 3 times the size of the pit that we began with. And we developed adjacent pits. We developed a couple of underground deposits. We've been producing gold in every which way from that Mulatos operation over the last 16 years. Now we've brought on 2 great mines here in Canada. We've got a wonderful opportunity at Island Gold to really create a world-class deposit, and putting it all together, that's 600,000 ounces of production. Over and above that, we have Lynn Lake, which I think is a very promising deposit. We've been adding ounces to it since it was acquired. We acquired it on amazing terms. We paid $22 million. It was sitting with roughly 1.6 million ounces of gold. Now it's probably closer to 2.6 million ounces of gold, and we can envision that again with greater than a 15-year mine life, and you know, adding more Canadian production. Again, it just means more and more of our net asset value is based in Canada. Right now, it's at just with what we have producing, our net asset value is 85% Canadian and 15% Mexico. Lynn Lake will tilt that a little further in that direction. So I think that's what to look forward to from Alamos. Mines that are located in solid jurisdictions that you could basically go to bed and not worry about you know, some crazy thing happening, a coup or an invasion. I don't know, name your thing. It's just been, the world's been a crazy place the last few years. The fact we've stayed focused on assets that are first quartile costs, and we're trying to climb to the top of that quartile. We want to be one of the lowest cost producers out there, and I think that that all adds up to a very profitable future for the company.
Well, it all sounds very promising, and that was a great overview and a great update on Alamos Gold. And I want to thank you for making the time today, John.
You're very welcome. It was a pleasure to be with you.
Hi, Rodrigo. Thank you very much for joining us today. How are things in Miami?
Things in Miami are awesome. Thank you very much, James, and thank you for the opportunity to be here with you.
I guess it's cooling off this time of year. Miami can be rather hot in the summer.
Yes, now only gets better now.
Rodrigo, Aurora recently won an award from the TSX for the best producing company on the TSX 30 for the second year in a row, I might add. But many investors in North America are not familiar with the company. So before we do a deep dive on Aurora, maybe you can just give us a brief overview of the company.
Sure. Aurora, we've been working in Aurora since 2017, a transformation process, preparing this company to do what we are doing today, generating cash and growing. So as of today, we have one copper gold mine in Mexico, Aranzazu, one gold mine in Honduras, one gold mine in Brazil, all of the three producing assets. On the top of that, projects greenfield to develop. One, Alamos, that we are now in construction, should enter in production in April. The other one, Matupá, which we should be releasing a new technical report to start construction next year. And recently we acquired Borborema, which used to belong to Big River, that we also plan to start construction next year.
So just to clarify, you have three producing mines and you are building three other mines.
Correct.
Another aspect of your company that I find interesting is that you used to be called Aura Minerals, but now you go by Aura 360. Maybe you can just tell us what the meaning is behind this.
Yeah, during all the transformation that I mentioned to you, that we started in 2017, we reassessed the company in terms of portfolio assets, balance sheet, and the team and culture. And the Aura 360 is very related to the team and culture, where we decentralized a lot of the technical decision into the operations, preparing the local team to make the best decisions and efficiently, to run those mines efficiently. But then those managers need to understand the impact of those decisions into the environment, into the communities, and into the employees. That's why we came with the concept Aura 360, which is to make sure every one of us and every single one of us is understanding the impact of our decisions, what is known today as ESG. We came with the Aura 360 in 2017, and now it's known as ESG, but this is the way we make our decision, understanding the impact of over all those variables.
As you mentioned, you have three producing mines, and your largest one is called Aranzazu, which is based in Mexico. Can you just provide a brief overview of this mine? How many ounces a year does it produce? And maybe all-in sustaining cost.
Sure. Aranzazu, it's a copper gold skarn underground in the state of Zacatecas, Mexico, that has been operated for over 15 years. We restarted this mine in 2018, and we've been gradually increasing production and gradually increasing our productivity at this mine. So last year, the guidance of this year is to produce in gold equivalent close to 115,000 ounces, and cash cost it's close to $700. And we do not yet have all-in sustaining cash costs. We are uniforming all our standards to be able to publish our all-in sustaining cash costs by the end of the year.
And your cash cost that you said is around $700 an ounce. Is that because of copper credits?
Yes, copper credits does help us to have a below $700 per ounce as a cash cost.
And copper is becoming more important with gold producers now. What % of your revenues come from copper?
We are now close to 25% of the revenues coming from copper. We have greenfield projects to develop all of them and gold. So copper should be diluted along the next 3 years. However, we continue to pursue M&A as a growth strategy, and we should look also copper to maintain a good balance for our shareholders.
Your next producing mine is called San Andre, and that's in Honduras. Can you just provide a brief overview of this mine? How many ounces does it produce? And maybe also touch on your cash costs.
San Andres is a mine that's been producing over 25 years. It's a heap leach, low grade, very disseminated gold with a very low strip ratio, 1-to-1, sometimes less than 1. That the guidance of this year is to produce between 75 to 80,000 ounces. Understanding that this year we hit it more mixed ore and the recoveries came below what we expected, but we are now moving to oxides, and next year we should increase recoveries to be able to produce at a lower cash cost and also a higher production. In terms of cash costs for San Andres, we are now below $800 as a cash cost, close to 770, 780. But we expect also this to decrease along the next years as we should hit higher grades and higher recoveries during the next 3 years.
And your last producing mine is called Ernesto. That's based in Brazil. Just provide us with a brief overview of this mine.
Ernesto mine is a mine that we ramped up back in 2016, so it's been operating for over 6 years. This is an open pit mixed with a very small underground, so 95% of the ore come from an open pit. CIL and grades close to 1 gram, 1.1, 1.2 grams per ton. And also together with, as well as with the Honduras, we are hitting now during the second semester, mostly on the last quarter of this year, higher grades, which will also improve our production and also decrease our cash costs.
And I'm sorry, what was the annual production at Ernesto?
It's a close to between 70 to 75,000 ounces this year.
So let's move on now. We discussed your 3 producing mines, but you're also building 3 mines. And I want to touch on your next mine that's going to go in production, which is called Alamos. Can you give us an update on this mine? Where exactly is it and how far are you along in terms of the construction phase?
Well, we have, as you mentioned, 3 greenfield projects to develop in the next 2 or 3 years. The first one that we are developing is Alamos. Alamos is a project, open pit CIL, simple project, simple to build, simple to operate in the state of Tocantins, Brazil, that we already started construction early this year. We are more than 65% now advanced, and we expect to start production in April next year, within the budget and within the schedule that we sent to the market early this year. Production of Alamos should be on the first years between 52, 55,000 ounces with significant potential to increase as we will be moving and invest in geology to increase the feed of the plant, and cash cost, all-in sustaining cash cost below $700 per ounce in the first 4 years. The important thing that I would highlight about Alamos is that we are building this plant at 1.3 million tons per year. However, we have identified many different targets very close to the plant that we will do exploration in order to find a new mine and be able to increase capacity of the plant so that we can also increase production. So we start with 1.3 million tons, but all the plant, all the designs, the infrastructure are being prepared to ramp it up to over 2 million, close to 2.5 million tons per year. But we'll do so after we can prove new resource and reserves around the plant.
And once again, this is going to start producing in April of 2023.
April 2023. I would also highlight the return of Alamos, as we could work to have a very simple project. It's going to cost us $74 million to build this plant that will produce 50, 55, or perhaps even more thousand ounces. And internal rate or return of Alamos is at 100% per year, leveraged at 50%. So it's a very good return and also short payback.
Rodrigo, you recently acquired a greenfield asset in Brazil called Big River Gold. Can you tell us about this asset? It's not yet in construction, but you're going to start construction soon. Can you just give us an overview on this asset and when that's going to start?
Well, Big River is to be a listed company in Australia that we just recently made a takeover offer and scheme of arrangement together with Dundee. Aura has 80% of this company now, and Dundee has 20%. This company has one project in Brazil ready to be built. It's a greenfield, fully licensed, that has close to 1.7 million ounces resources and reserves. And we plan to start the construction of this project during next year. It could be early next year, first semester, or the second semester. What we're gonna do is, during the next couple of months, go to the project, re-engineer things, see if we can find optimizations, and then convert the JORC into 43101. And by the end of the year or early next year, we'll inform the market if we're gonna start the construction of Borborema the first semester, or if you're going to start the construction during the second semester.
So you have a lot going on. Your guidance for 2022 is 260 to 275,000 ounces for the year, but you have a path to 400,000 ounces by 2024. So maybe you can just summarize for us how you're going to go from 275,000 ounces to 400,000 ounces with all of these assets that we just discussed.
As I mentioned to you, we still have some room to improve the production where we are already producing the three assets. Honduras moving to higher grades and higher recoveries, Brazil the same. But most of the additional production comes from two projects that we are developing, or perhaps three. Number one is Alamos, that we are in construction, more than 65% advanced, start production by April next year. This project should give annualized 55,000 ounces of production, give or take. And Matupá or Borborema, the other two greenfield projects that we have, that we should start construction next year, should also add Matupá. If we start the construction early next year and Borborema during the second semester, Matupá entering production by 24, and that will add additional 55, 60,000 ounces of production on the first years. So Matupá and Almas, together with the improvements of the projects that we already have, will be able to reach 400,000 ounces. Or if we start Borborema first before Matupá, then it will be Borborema and Almas to 400,000 ounces by 24. And of course, moving beyond that, as we will still have one greenfield that will be in construction next year and we will enter in production by 25.
Rodrigo, I guess the one thing that really stands out to me is that you have a lot going on. In addition to your three producing mines, you have another mine that's going to be coming on in early 2023, and you're going to be building two other mines. Do you have the technical team in place to manage all of these various projects?
We do have a very good technical team, although when we move to construction of other two projects during next year, we might have to increase a little bit our technical team. However, I would highlight that the three greenfield projects that we are developing and being built during next year, all of them are in Brazil. We are a country that has a very extensive story developing mines, have good engineering school, good consultants. So Brazil has plenty of labor skilled to develop those projects. And the thing is, we will also sequence the projects in order not to get full attention from the same team at the same time. For example, Almas, we will start the construction of either Borborema or Matupá first semester next year, when exactly we'll start production of Almas. And the other project, we should start construction by the second semester so that we can sequence doing land work in one project. When we start building a plant, then you do land work in another one. And then when finish this one, you start doing the plant in the other side, in all the infrastructure. So sequencing will also help us to be able to manage them efficiently. And I would highlight the team is so good that despite all this inflation and all the pressure that we've been seeing all over the world, we've been able so far to build Alamos on budget and on time, according to what we released to the market early this year.
Rodrigo, I want to move on now and discuss your balance sheet because you do have so much going on, especially with the construction of these various assets. Your finances is very important. Can you just tell us how much cash do you currently have on hand?
Yes, last quarter we finished with over $220 million of cash, understanding that a couple of weeks ago we paid for the acquisition of Big River, which was $51.6 million. So we should be around slightly below $200 million and continue to invest in Alamos and also continue to generate cash from an operation. What I would highlight, which is very important, is as well as we sequence not to get the project, the construction, in order not to have full attention from our management team, we are also sequencing in terms of cash flow. So with the strong position that we have on cash flow, it's a very short payback that we have in Alamos, Matupá, and Borborema. All those projects should be close, if not less than 2 years. So we've been able to recycle capital very fast while we are also producing our operations, coming from a strong balance sheet. So we will be able to continue to grow, pay dividends without having to access the equity capital market in the next 2 or 3 years.
Okay, you just mentioned dividends, and we should touch on this because you also have a very aggressive dividend policy. Why don't you tell us about that policy and remind me again, how much do you pay out last year in dividends?
Last year, we paid $85 million as a dividend, which generated a yield for our shareholders at 13.5%, one of the highest in the industry. The way we built the strategy of Aura that was just since 2017 is to get into projects that are simple to build, easy to operate, short payback, and high returns. Not necessarily very large projects, but very high returns. So the payback of those projects that we are building is less than 2 years, 1 year on equity. So as we are sequencing the construction, Alamos, Borborema or Matupá, and then the other one, we'll be able to continue to generate cash, continue to grow while we'll be able also to continue to pay dividends. That's why we approved 2 years ago a dividend policy of 20% minus recurring capex, not including the expansion capex for the greenfield projects. And this year we are now paying biannually. We paid between dividends and share buyback a yield to our shareholder at 3.4% in the semester, which is annualized close to 7%.
Rodrigo, as we wrap up, you and your team have generated a lot of value in the last few years for your shareholders. How will you unlock value in the months to come?
Yeah, James, I would say that we're just in the beginning. I think, of course, collecting the first fruits of the hard work we did in the first 3 years of the transformation of the company. However, we built a very strong portfolio that we will continue to generate value to our shareholders during the next years. How this is going to be, we're going to unlock value from 3 different areas to our shareholders in Aura. Number one, we have greenfield projects to develop. We have the execution risk, so we want to deliver the projects on time and on budget that will also add value to our shareholders. Number two, this company has underinvested in terms of geology and exploration. It's still our potential, its geological potential, it's unknown. For example, we have 650,000 hectares around the mines that we already operate on the project that's going to be developed. And Aura, just 5-6 years ago, was just investing $2 or $3 million in geology and exploration. Just last year, we started to invest in exploration close to $22 million. This year should be close to $25 million. And some results has been very enthusiastic. We have been very enthusiastic about the results. For example, in Matupá, a project that we should start construction next year, we continue to do exploration and we hit it. And we shared with the market recently 81 meters at 3.89 grams per ton, 51 meters at 3.14 grams per ton. So that shows the potential that we still have increasing resources and reserves of operating mines as we grow in terms of exploration. And the third variable that is going to unlock significant value to our shareholders is the multiple per NAV. Although we've been number one TSX in 2021, number one TSX in 2022, we are still discounted compared to our peers. And our peers are the companies that produce 200, 300, 400,000 ounces that normally trades at 0.4 times NAV. Companies that has 600,000 ounces, 700, 800,000 ounces of year production, normally they trade at 0.7, 0.8 times per NAV. So we know very much how to get over 400,000 ounces. Only Almas and Matupá put us at 400,000 ounces. The last acquisition that we made will move beyond that. So we know how to get close to 500,000 ounces. However, we still continue, and we have a strong balance sheet, a very strong team. We continue to pursue M&As in order to push our production above 500,000 ounces so that we can change the peers and change the multiple. So we'll be unlocking value by execution, building the projects, exploration, increasing resources and reserves, and changing the multiple.
Well, Rodrigo, I want to thank you very much for spending time with us today. That was a great introduction of the Aura story. Once again, thank you.
Thank you very much, James, and it was very nice to be here with you.
Hi, George. Thank you very much for joining us today. How are things in Vancouver?
Things are really good. Weather's still great. We're moving into fall, but blue skies and perfect weather.
Yes, fall is an amazing time to be in British Columbia. George, Eldorado recently announced the key development at your Skouries project, and that is the credit committee approved mandate letter for 680 million euros. And I want to discuss this and exactly what it means for the construction of Skouries. But before we do that, why don't we just start with a brief overview of Eldorado Gold for those viewers who might not be familiar with the company?
Sure. So Eldorado is a diversified portfolio of long life, high quality assets. For those not familiar with the company, we have 4 operating mines in key jurisdictions, Turkey, Greece, and Canada. And our main production is gold, although we have byproducts in silver, lead, and zinc. And with Skouries, we'll be adding copper to the portfolio. And we currently have 15 million ounces of proven and probable reserves and a big exploration program to continue to grow both our resources and our reserves. And I think the thing that sets us apart from many of our peers, we're a growth story. We have a strong pipeline of growth projects, both from our 4 operating mines as well as our development projects in Greece.
So that's a great overview. I want to move on now and spend a little more time on your various operations, beginning with Kışladağ. That's your largest producing mine. You produced 170,000 ounces there in 2021. Can you just provide a brief overview of this mine in terms of production, also your cash costs and your all-in sustaining costs, and just how things are producing or progressing overall this year?
Sure. So Kışladağ's a flagship operation for us. It's an open pit, heap leaching mine. In 2021, we had a strong year. In this year, first quarter, we had a slow start. We were impacted by COVID absenteeism. We also had a pretty tough winter in Turkey. And as a result, we had a soft Q1. We've been ramping up since then, solid Q2. We're set up to have a lot stronger second half than first half. And really our focus here has been on capital and improving the efficiencies of this operation. So at the end of last year, we commissioned a high pressure grinding roll. It's essentially an improved crushing facility that will crush the rock finer, expose more gold, and therefore deliver higher recoveries. And with that new crusher commission the end of last year, we're focused now on agglomeration. In agglomeration, we're basically adding cement to the stacked ore in order to bind the fines together to maintain permeability on the heap. And by having a finer crush and a good agglomerated ore, we can then irrigate solutions through and push that recovery to what we're now budgeted and forecast to do is 56% gold recovery. So far, all of our work is indicating that 56% is deliverable and we're on track. But we're not happy with this. We're focused on even further improvement. And the work on agglomeration has shown us that, number one, we can crush finer with this new crusher. And with good agglomeration, we think we can even get the recoveries higher. So as a result, mid-year, we announced that we're investing in an agglomeration drum. And essentially with that drum installed in the crushing facility, it'll give us the ability to crush the rock finer, to agglomerate the ore effectively, and maintain that permeability. So we're doing all the test work to determine ultimate recoveries with this new circuit, and look forward to positive updates on Kışladağ's future as we approach 2023.
Your second producing mine I want to discuss is Lamaque, and that's an underground mine based in Val-d'Or, Quebec, which translates into Valley of Gold. So that implies there's a lot of gold in this area. But maybe you can just provide an overview of this mine in terms of annual production and also your all-in sustaining costs.
Yeah, so Lamaque's our newest operation. We acquired it in 2017. It's been a huge success story for the company. We brought it into commercial production within less than 2 years of acquisition, and we've been growing the reserves and the resources since acquisition. In the maiden feasibility study, we had a peak production level of 130,000 ounces per year. We're now peaked at over 200,000 ounces a year. We've made a new discovery since acquisition. We call this discovery the Ormaque deposit. And the Ormaque deposit essentially is a separate deposit. And we just late last year in December completed a drift or a decline between our mill, our Sigma mill, and our Triangle underground mine, where all our production is coming from. And this decline runs just adjacent to the Ormaque deposit, so it's well positioned to put into production. The next step is to be able to convert the inferred resources to reserves, and that'll allow us to extend mine life at the Lamaque operation. Again, it's a solid producer. It peaks at about 200,000 ounces a year, and we believe we'll be able to extend mine life here with our strong exploration programs.
And George, maybe you can just give us a timeline associated with that. How much more work do you have to do, and how long would this work take before you can actually bring Ormaque into the mine plan?
Yeah, we have a long section that depicts this pretty well. We on our long section, we've got historical gold that had been mined over a couple of decades on the right side of the slide, and on the left side of the slide, we have the Triangle deposit where our production, our current life of mine comes from. And right in between the two is this new Ormaque discovery. So in the second quarter, we completed an exploration drift off the decline, and we began the infill drilling. We should complete the drilling before the end of 2023 to give us the required drill density to then convert this into a reserve. Now, we've done the engineering studies. We have a PEA that went out in the second quarter of this year. So we're well positioned to understand the engineering capital infrastructure required. Really, the focus now is the detailed drilling to give us the confidence to be able to call it a reserve. And right now, our expectation is to be able to announce a maiden reserve on this late in 2023.
So your third asset that I want to touch on is Skouries, and there was some big news that came out in Q3 on this, and I want to do a deeper dive on it. But before we do that, why don't you just provide us with a brief overview of this asset and maybe just highlighting the high points from the feasibility study, the net present value, the IRR, CapEx, et cetera.
Yeah, Skouries is a transformational project for Eldorado, and the feasibility study was completed in December. It has robust economics. The capital cost to complete the project is $845 million. The IRR is 19%. The payback's less than 4 years. One of the unique things about this mine is that the copper will cover all the operating and sustaining capital costs. So it has a negative all-in sustaining cost of negative $17 per ounce. And it's going to produce, on average, over a 23-year mine life, 140,000 ounces of gold and 172,000 ounces of gold equivalent coming from the copper byproduct. And now all these economics I just cited are assuming a copper price of $3.85 and a gold price of $1,500 an ounce. So, right now, gold price is quite a bit stronger than our assumed price, and copper slightly below those assumptions. At any rate, this is a long life asset, high quality asset's really going to change Eldorado and provide a heck of a lot of cash flow to our shareholders.
And copper seems to be becoming more and more important for gold producers.
Copper's a unique metal in that, the planet is focused on decarbonization. Copper is going to play an important role in that journey as everybody focuses on clean energy. And so although we're kind of going through a global economic crisis, I think copper is going to have a strong run for the next decade as those focuses on clean energy continue to unfold. And so, yeah, as a gold company, having an asset that has a nice byproduct in copper, it's definitely going to be a strength for our organization.
George, you mentioned that it will cost $845 million to complete the construction of this. So financing is a very important issue here. And as we mentioned at the onset, you recently announced an important milestone in the Skouries financing process, which is a credit committee approved mandate letter for 680 million euros with Greek banks. And some investors might not be familiar with a mandate letter. Maybe you can just provide an overview of what exactly it is and what it means for this whole process.
Yeah, this is an important milestone for the company. Getting this approved, this mandate approved with the Greek banks, signals that we're getting close to having financing in place. That financing package will cover 80% of the required funding to complete the Skouries project. We've essentially agreed on key terms. This is non-binding at this point, but to give you an idea of the depth at which we currently sit, the term sheet that went along with the mandate letter is over 50 pages. So we've discussed a heck of a lot of the issues. What remains are finalizing the key commercial terms. This is going to be a key focus for Eldorado, and we're expecting to be able to close the financing by the end of this year.
50 pages, that must be a very detailed letter.
Yeah, I mean, both the banks and Eldorado wanted to hammer out the key terms before we dived into the detailed documents. So I think we're pretty well positioned to get this finalized before the end of the year.
So best case scenario, you get it finalized by the end of the year, and then what are the next steps?
Well, really, it's getting the approval from our board to finalize the financing and to approve the full construction of the project. And so, we remain pretty darn confident. Our feasibility study was completed in December of last year, and we believe that the capital cost in that feasibility study is still solid.
And so I just want to get a timeline associated with this. Best case scenario, when could you actually move ahead with the construction?
Yeah, we're poised with the team in place to start construction right after approval in the new year.
George, there's been a lot of examples of capital cost inflations with some of your competitors. How comfortable are you in the Skouries capital estimate of $845 million?
Yeah, we're quite comfortable with our capital cost estimate from our December feasibility study. And there's a couple of distinctions about Skouries that sets us apart with those companies that have been struggling with inflationary pressure. Number one, the main equipment in the processing facility is not only purchased, but it's already in place. So crushing, grinding, flotation, concentrate regrind, all the main equipment associated with that part of the processing facility has been installed. In fact, over the summer, we've been putting up the mill building and the cladding or the siding on the facility. The open pit's already been pre-stripped and the ore body is exposed. So, those parts are largely de-risked. One of the key things this year that gives us further confidence that our capital cost estimate is solid is that some of the work yet to be completed is we've committed to dry stack tailings. That means we're going to remove the water from the tailings and convey kind of a damped sand into the valley below. So in order to do the dry stack, we have to purchase these large filters that will remove the water from the tailings. And that's the last major piece of equipment to be procured. So we went out for tender in the second quarter of the year. We finalized a contract with the supplier, and the cost for those filters came in slightly below our feasibility study cost estimate. So that was a really good sign for us that our estimate's still solid. Another indication, there's still a lot of construction to be done on the tailings dam itself. We're building a lift on a tailings facility for Olympias. It's within 15 kilometers of Skouries. And the productivities and efficiencies we're seeing on that construction activity is consistent with the assumptions we have on Skouries. And so, there's a few indicators that are telling us that we're still in solid shape relative to our feasibility study.
So that's a great overview of Skouries. I want to move on now, and I want to discuss exploration. Of course, is a very important element of any mining company, but maybe you can just give us an overview. You just recently released a press release on exploration, but maybe you can give us an overview on how you're going to allocate your budget this year.
Yeah, our exploration guidance for the year is $44 to $48 million expenditure. And it's about 53% expensed and 47% capitalized. And breaking that down across the jurisdictions, we're doing a lot of drilling. In Canada, we have 112,000 meters of planned drilling, and that includes 22,000 meters of resource. In Turkey, 67,000 meters of planned drilling. 38,000 of that is resource conversion at Efemçukuru. And in Greece, we have about 27,000 meters of planned drilling, including 7,000 meters of resource conversion drilling. And that's at Olympias. So we got a pretty robust exploration budget. More than half is focused on Canada, and we've got a large land package, and I think a long runway ahead of us. And Ormaque is the next step in terms of growing our reserves and extending mine life. And the other thing I would say is Efemçukuru has been a really steady producer for Eldorado since startup, and we have inferred resources that we're currently drilling on, and think we've got a good opportunity here to extend mine life of this very steady asset. And in Greece, again for Olympias, we're doing resource conversion drilling. Our exploration announcement that just came out shows some fairly exciting new intercepts close to surface, not too far from infrastructure, and so we'll continue to pursue these opportunities at Olympias in this Stratoni corridor in Greece.
So as you just mentioned, you have a very large exploration program going on, and you have a lot going on at your various operations. So why don't we move on and discuss financing and your balance sheet? How much cash do you have on hand, and how will you allocate that cash in the coming year? Are you going to focus on CapEx or dividends or buybacks?
Yeah, for Eldorado, maybe starting with our liquidity position, the total liquidity is $620 million at mid-year. That's $370 million in cash and $250 million in an untapped revolving credit facility. So we're well positioned on the balance sheet side. And I mentioned for Skouries, 80% of that project we're anticipating financing through Greek banks. The remaining 20% would come off our balance sheet, and so we're well positioned to be able to deliver on that. And so when you look at our debt, we have $500 million senior notes at 6.25%. And so we've got a good runway to be able to get the growth in our existing 4 mines delivered over the next 5 years. And while we're doing that, get Skouries completed and in construction. That's about a 2.5-year project in order to get it into initial production. and about 3 years to get it into commercial production. So we're well positioned within our 5-year guidance to make a material change in our production, a material change in our unit cost, and a material change in our ability to deliver free cash flow. And so once Skouries up and running, we'll be in a position then to look at share buybacks or dividends.
George, you just gave us a very robust update on your various operations and what's happening, and you're making great progress at Skouries in Greece, and yet you're still trading at a significant discount to your comps. What are you and your team going to do to help unlock that value in the coming year?
Yeah, for Eldorado, our price to NAV is definitely below our peer group, roughly half our peer average. And that disconnect is solely due to Skouries and our growth in Greece. And so, we're locked on changing that. It's get the financing in place by the end of 2022, put it into full construction in early 2023, and deliver a project on budget, on schedule in 2.5 to 3 years. And so that's going to remark Eldorado. We'll become a large generator of free cash flow, and you're going to see that PNAV improve dramatically against the peer group. And I think that just is a unique opportunity for shareholders to take advantage of a re-rate of Eldorado as we deliver on the Skouries project and our growth across our portfolio.
And George, before we wrap it up, you and your team were recently at the Denver Gold Forum last month, and I'm just kind of curious, what was the mood like there? And I'm sure you met with numerous institutional investors. Maybe you can tell us what sort of feedback you got from them.
Yeah, I mean, it's been a significant change. So Eldorado presented a year ago at the Denver Gold Forum, and it was a hybrid event. So a significant change in the number of companies that were there this year. It was a full plate of companies. I would say off the mark from historical norms in terms of the investors. We were quite busy. We had a full docket of meetings during the event, and so we were pleased with that. And I'd say the mood is trying to get some excitement from the generalists. And again, I think our sector is going to show some good opportunities as the overall global recessionary fears step away. And I think Eldorado is well positioned within the peer group to deliver value to shareholders as described in this discussion.
George, as we wrap up, what can investors expect in terms of news flow from Eldorado Gold in the coming months?
Well, at Eldorado, we're focused on delivering our operational guidance for 2022. And as I said, we're going to have a lot stronger second half than first half. And beyond that, it's our growth. And so in Turkey, we're focused on throughput and recovery improvements at Kışladağ. At Efemçukuru, it's resource conversion of the Kokar, Pınar, and Batay veins, which can extend the mine life. Kind of swinging over to Canada, our focus here is on the resource conversion drilling on our Mock. Again, that's going to evolve at the end of 2023. We believe we'll announce a maiden reserve late in 2023, and that'll have a material impact on the value of Lamaque. And in Greece, it's really the transformational opportunity of getting Skouries financed and in full construction and ultimately into commercial production. So a lot on our plate and a lot of opportunity for the company and for our shareholders.
Well, that was a great overview, George, and a great update on Eldorado Gold, and we look forward to further announcements, especially at Skouries. But I want to thank you for making time for us today.
I appreciate the opportunity.
Hi, I hope you're enjoying the conference. Just a friendly reminder to subscribe to our channel, Bloor Street Capital, and also give us a like and leave a comment. Thank you for your support. Hi, Ronnie. Thank you very much for joining us today. How are things in Vienna?
Very good. Thanks for having me, Jim.
Ronnie, 2022 has been a fascinating year with the S&P down 20%, the NASDAQ down 30%, and Bitcoin down over 50%. Trillions of dollars have been wiped out, and I want to touch on all of these subjects. But before we do that, why don't we just start with a brief overview of your firm, Incrementum? Where is the firm based, and what services does it offer?
Well, we are based in Liechtenstein, which is a very, very small country in the center of Europe, 35,000 people living there. It's one of 5 countries worldwide without any government debt, so that's pretty fascinating. And it's a beautiful, beautiful place. And we are 2 partners from Switzerland, 2 from Austria, 1 from Germany, and we basically met in the middle in Liechtenstein. So what do we do at Incrementum? First of all, wealth management for high net worth individuals. Then we do manage 6 investment funds, most of them in the precious metals and commodity space. So we've got 1 uranium fund, we've got 1 mining fund. I'm managing a inflation protection fund. We've got 2 funds that combine gold and silver in general with Bitcoin. So that's definitely very unique. And I think most people know us because of our In Gold We Trust report. I started publishing this report almost 15 years ago when I was still a young kid sitting in a bank without any clue about the monetary system, about gold, no clue what sound money is, no clue about the Austrian economics. So over the last 15 years, we wrote lots of research about the topic of gold, and the In Gold We Trust report is nowadays probably the most widely followed publication on gold. So we publish in German, English, Mandarin, and also in Spanish. And for the last edition, we almost had 2 million readers. So it's really a quite a success nowadays.
The title of the latest edition of In Gold We Trust is Stagflation 2.0, and the last time we had stagflation was in the 1970s. Can you just expand on why you chose this title?
Well, actually, we chose this title already in fall 2021. And back then, stagflation wasn't really a big topic, but we said, well, actually, the way inflation is developing, we didn't really believe that it's only transitory. And let's not forget, until very recently, all central bankers basically told us, it's transitory, it's gonna come down. Christine Lagarde said it's only a hump, so it's a hump. I said, well, it's a very, very big hump, like the Himalaya. But we were quite critical, and we said, well, actually, there's lots of structural drivers for this inflationary pressure that we're seeing. It's obviously the deglobalization that is happening. It is structurally, we're seeing that fiscal stimulus has a much more direct impact on inflation numbers compared to monetary policy, and then obviously lots of pressure coming from the labor market and so on. So we said stagflation will become a topic, and then we read quite a lot about stagflation and realized actually there is no quantitative definition of stagflation. So it's mostly qualitative, and so we came up with our own definition of stagflation, and we came up with an indicator for the strength of stagflation, and then crunched the numbers and researched what works in stagflation and what doesn't work. So that was basically the reason. And why stagflation 2.0? Because obviously history repeats and it rhymes, but and there's lots of similarities between the current setup and the setup in the 1970s, but there's also many differences. And I think the major difference obviously is the level of debt. So on a corporate level, on a private level, but also on a government level, debt levels are significantly higher, twice or even 3 times as high compared to the 1970s. So I just don't believe that Jay Powell is the new Paul Volcker. I just don't see it, because obviously due to this enormous debt burden, the sensitivity to rising interest rates is so much higher than you know, when Paul Volcker was around, that we are already seeing at the moment that so many markets, so many different pockets of the market are already breaking. So I think this would be the major difference between the stagflation of the 1970s and the current stagflation.
You've mentioned in the past that there are three phases of inflation: monetary inflation, asset price inflation, and consumer inflation. The Fed has lifted interest rates 5 times since March. Do you think they've been successful in bringing down consumer inflation?
So far, they haven't been, yeah, because obviously CPI hasn't come down really. PCE, or core inflation, didn't really come down either. But I think, you know, I mean, let's take a step back, Jimmy, and I think it was really the article and also some interviews that Bill Dudley, former, I think, vice chair of the FOMC and head of the Federal Reserve New York, he did basically explain it already in April with his thoughts about the so-called reverse wealth effect. So basically, the game plan of the Federal Reserve was, well, you know, we cannot really solve the energy problem. We cannot solve all the issues that we have on the supply side. So actually, we have to tackle it from the demand side. So through this negative or reverse wealth effect, by bringing down asset prices, equities, bonds, and also real estate, they wanted to influence aggregate demand, which leads to a soft landing or a mild recession. So that was the game plan. And actually, you know, I think this plan already sounds pretty, let me find a polite word, creative and let's say interesting in theory. And from my point of view, there's no way that this will really go out well. And you know, just to give our audience a perspective, since the beginning of the year, 60 trillion globally were wiped out in equity markets, in bond markets, in real estate, in commodity markets, in the crypto market. 60 trillion, that's I think roughly 65% of global GDP. That's a huge number. So actually, on an absolute basis, this is the biggest destruction of wealth ever. Now, obviously, people feel less rich. People, you know, stop purchases, they reconsider their spending behavior and so on. So that obviously works, but it also causes enormous problems for, let's say, parts of the market that were already, you know, under some stress. Now, you know, in 2020, one of the biggest shocks in recent history, actually fiscal policy bailed us out, and there were basically no bankruptcies in 2020, and already in 2019 I wrote that a recession is on the horizon. I didn't know that you know, COVID would be the trigger and the catalyst, and obviously I didn't expect a virus to appear from a laboratory in Wuhan or wherever. However, the recessionary clouds were already kind of gathering. Now in 2020, the recession happened, triggered because of the lockdowns, and then still fiscal policy stepped in. So my take has been that actually all those zombie companies and also zombie consumers, they got a bailout. But still, you know, they are very, their fiscal or their financial stance is very, let's say, fragile. And I think, you know, this fragility is kind of now appearing in this development. As I've said before, we've got the highest debt levels ever. Therefore, the sensitivity to rising rates is higher than ever. And let's face it, 1 year ago, interest rates were at 0. Now we are heading to 4.5. Some analysts are even expect 5% by the middle of next year. So that's a huge move on the rate side, and I just don't see this ending in just a mild recession or in a soft landing. I just don't see it. And I think the consequences or the effects that we're seeing now in financial markets, we saw major troubles in the British bond market. So actually the pension funds in the UK got a bailout from the Bank of England. We see huge cracks appearing in Japan. We see that major banks like Credit Suisse, but also Deutsche Bank in Europe are under severe stress. Just have a look at their CDS. So actually, those are the consequences of the rate hikes and the tightening that already happened over the last couple of weeks. Now, if they continue with that policy, we're not talking about a recession, we're talking about a depression. So I think, the pivot will come at some point. I don't believe the narrative that the Federal Reserve is now being ruled by hawkish Jay Powell. I just don't see that. But I think they're completely underestimating the time lags that are involved, and therefore, I think it's gonna be interesting over the next couple of weeks, to use a very diplomatic word.
You touched on the US dollar, and the US dollar index, it's up 15% on the year, give or take. Where do you see it going?
Well, I did a fireside talk with my friend John Hathaway at the Precious Metal Summit recently, and back then I think the Dixie index, which is very much driven by the euro, I think it's 54% of the weighting. I think back then it was trading at 106 or 107, and I said it can go to 120, and people said, wow, that's a pretty gloomy forecast. And actually we went to, I think, 115, 116 within the next 2 or 3 weeks. So from a technical point of view, I could see some sort of a bear market rally in the euro, but from a longer term view, I just don't see any secular strength, euro versus US dollar. I think what's interesting, Jimmy, is the fact that the US dollar is so strong versus the Japanese yen. And I always said, if you want to know the future of monetary policy, just look at what the Bank of Japan is doing. They're a couple of steps ahead. So the Japanese yen is, that's like really the 8th or the 9th inning probably of this monetary end game. But then it's also the weakness in the euro and also in the British pound. So I mean, those are not three unimportant currencies: the yen, the euro, and the British pound. However, versus, for example, the Brazilian real, actually the US dollar is trading kind of flat. And I could see strength of the US dollar going forward versus most other G7 currencies, but weakness measured in commodity terms. So this is a little bit of a the forecast that I have for the next couple of weeks, or for the next couple of months actually. And obviously everybody is just waiting for the big pivot coming from the Federal Reserve, and this would go hand in hand with the peak in the US dollar. I'm not so sure about that. I think the dollar could also die because of its strength and not because of its weakness. So perhaps, if we read monetary history, we had like the Plaza Accord meetings, for example, because of the strength in the US dollar, and it was a kind of similar setup with what led to the Plaza Accord. So I think that something like that could happen within the next 2 or 3 years.
So we discussed interest rates, we touched on the US dollar and also inflation. Why don't we bring all of these elements together and discuss their impact on gold? Oil went to $125, copper's traded up to $5 a pound, Bitcoin's gone up to $68,000, and we've always been taught that one of the benefits of holding gold is its protection against inflation. But in spite of all these moves that we've seen in these other asset classes, gold really hasn't moved. Why?
The thing is, I think that gold is doing just fine. Gold is, for example, this year to date, in euro terms, gold is up 8%. In Japanese yen terms, it's up 17%. In British pound terms, it's up 14%. In dollar terms, it's down 5%. So actually, obviously, the US dollar was the big topic this year. And if you got the dollar right, this year you had a fantastic year as an asset manager. Now, you mentioned the enormous drawdowns that we saw in basically all asset classes, and you know, equities are down, especially the tech stocks that, you know, everybody said, well, this is like the nifty 50s of today's world. You cannot do wrong with buying the ARK ETF or buying Tesla, Facebook, Alphabet, whatever. But now we're seeing, well, actually those drawdowns are pretty significant. We saw it in the crypto space, obviously. We saw it in the bond market. I mean, the global bond markets have their weakest year since the year 1865. So that's pretty significant. Now, gold, I think it's, you know, expectations were perhaps a little bit too high. But I think that in hindsight, I have to say, you know, let's be frank. If you would have told me last year, or if you would have asked me last year, you know, inflation is at 8%, there's a war in Europe, where would you see the price of gold? I probably wouldn't have said 1700. To be honest, I would have expected a little bit more. However, as I've said before, 60 trillion drawdown in global asset prices. I think we're now a little bit in this environment like in 2008, where actually gold was up big time, made new all-time highs. And then in those very, very turbulent weeks in September and October, it traded down and ended the year still, I think, with plus 5 or 6%, while everything else was down. Because gold, first of all, it was liquidated. Institutional players, funds, but also private individuals just needed liquidity. And what do you usually sell in such a liquidity event? Whatever asset is very liquid and has a small bid-ask spread, and gold, you know, it's one of the most liquid assets out there. Its trading volume is 140 billion per day. So I think that's one of the reasons. And then obviously, I think that gold is already kind of sniffing out this pivot that will happen at some point. So that makes me pretty confident going forward for gold.
So as you mentioned, gold is down small on the year, but many producers are down 20, 30% or more. And a lot of them have little or no debt. They're cash flowing, they're buying back stock, they're paying dividends, but they're down significantly more. Why?
Well, obviously, you know, price of gold is down, and still many companies are experiencing inflation on the cost side, not only labor, but also all sorts of materials. Obviously, energy is a huge driver. However, as I've said, I did visit the two big mining shows, and I had 74 one-on-one meetings. And there's obviously, you know, for some companies, especially the smaller ones, it seems that hope is their business strategy. But then when it comes to the large caps and also the royalties and streamers, I you know, as a kind of a value investor, it really, you know, I really got excited. So I'm seeing pristine balance sheets. I'm seeing management teams that really focus on shareholder value, buying back stocks, increasing dividends. Debt burdens have been released significantly, and I think there will be some spectacular M&A news coming out over the next couple of weeks. I think that the majors will use their financial capabilities to make good acquisitions. Hopefully at the low point of the market, because most of the time those big acquisitions are made at the top. And I just see that, you know, there's very, you know, I'm following the mining space for 15 years now, and probably I've never seen the mining industry in a better shape. For the large caps, especially for the developers, it's tough out there because, you know, cost of capital are rising. Then we're seeing, of course, risk appetite isn't that good anymore compared to the, you know, a couple of months ago. And then obviously, if you produced a PEA a couple of months ago, well, actually, you know, it's worth less now because costs are rising that dramatically. So that's a tough spot. Companies developing projects now going into production in 2030, whatever, they will face a hard time, but still great projects will always be built, and there's quite a number of really good projects out there.
Ronnie, I'm going to digress now. You have a very vast book collection. What's your favorite business book? Is there one book that you've read 2 or 3 times?
There's many books that I read a couple of times, and actually, I think it's like reading a book just once is like listening to a good music album just once. You know, the more often you hear it, you know, the more you appreciate all those fine details. And it's the same with books, and especially if you develop as a human being. There's a couple of books that I read like 10 times, and every time I learn more about it. I think one of the best ones out there is The World of Yesterday by Stefan Zweig, where he describes the hyperinflation in Austria and then the hyperinflation in Germany 100 years ago, 1923, and what inflation does to society. Actually, I think that's a fabulous book. Then obviously Lords of Finance is a fantastic book, and then there's, I mean, that's a pretty light reading. That's Modern Central Banking Simplified, and it quotes former Chairman Ben Bernanke and says the U.S. government has a technology called a printing press, or today its electronic equivalent, that allows it to produce as many US dollars as it wishes at no cost. And I got this book from, I don't know who sent it to me. It was like a reader of the Gold with Trust report, and I thought it's pretty interesting. And it says, print money, print money, print money, print money, print money. And at the end, it says, keep on printing. And actually, it's really financial or modern central banking simplified. And again, I just don't see that there's really, I just don't see this hawkish narrative playing out. I think they are playing this role. They're playing this role very, very well. But now, as so many markets are actually breaking, they will make the pivot, and I think, you know, their next measures will be much more aggressive. So actually, I think this is a very, very timely read at the moment.
Ronnie, that was a fascinating discussion, and I want to thank you for making time for us today. I would encourage all of our viewers to check out the Incrementum website. That's incrementum.li. It has a wealth of information pertaining to all things gold, including the Bible and Gold We Trust, which is free. Once again, Ronnie, thank you.
Thank you very much. I really enjoyed this. Thank you very much for having me.
Hi, Greg. Thank you very much for joining us today. How are things in Salt Lake City?
They're very good, Jimmy. Nice to see you again.
Likewise. Greg, Novagold is unique in so many ways, beginning with the sheer size and scale of the Donlin Gold project. But before we get into the details of Donlin Gold, why don't we first start with a brief overview of Novagold for those viewers who might not be familiar with the company?
Well, Jimmy, Novagold is a single asset company, and our focus for many years has been the Donlin Gold project up in Alaska. We own 50% of this asset. Our partner, Barrick Gold, one of the largest gold producers in the industry, owns the other 50%. Donlin is one of the largest, highest grade open pit deposits in the industry, located in Alaska, about 300 miles due west of Anchorage.
Greg, as you mentioned, Novagold has many unique features which make it a tier 1 asset, and I want to spend some more time on these elements to really reinforce just how special this asset is. Why don't we just begin with how many ounces you have and then move on to the grade?
Donlin Gold is one of the truly strategic assets in the gold space. The measured and indicated reserves are about 40 million ounces, with another 6 million ounces inferred in and around the known deposits. It's also a very high grade deposit at 2.25 grams. It's one of the highest grade undeveloped gold properties out there. And you have to go back in time about 10 years when the industry had a grade of 2.25 grams. Industry-wide now, the grade is closer to a gram, which really makes the Donlin project stand out among the other undeveloped gold properties in the industry.
And maybe you can just expand on that. Why have the grades kept going down, and why are the grades so high at Donlin?
Well, the grades throughout the industry have been steadily declining. That's not a new phenomenon. It's driven in part by, as the mines are depleting, they've mined the better grades first. Also, as gold prices have increased, this has allowed the producers to lower their cutoff grades, which effectively makes lower grade ounces economic, but has the collateral effect of lowering their average grades.
And you mentioned that it has just under 40 million ounces. Put that into perspective for us. How many other deposits out there are that size?
Well, Donlin is really unique in that regard. The other large scale development project that's comparable to Donlin is the Sukhoi Log project in Russia. All of the other gold deposits are on average about a third the size of Donlin and significantly less grade. Most of the projects other companies are advancing are more industry average grade, which is to say about a gram.
So let's talk about the mine life. This is another very unique feature. What is the mine life?
Well, Donlin Gold, as envisioned in the feasibility study, has a mine life of almost 30 years. During that period of time, it would produce about 1.5 million ounces a year for the first 5 years, followed by several decades of about 1 million ounces a year. There's a 1 million ounce producer is a very rare phenomena in today's industry. Only a handful of mines are at that level, and many of these mines have been around for a long time and are steadily declining in production.
Greg, let's move on now and discuss your exploration campaign. You've had a very aggressive drilling campaign in the last couple of years. In 2021, you drilled 79 holes or 24,000 meters. Tell us what's happening in 2022.
Well, we've just finished up the largest drill campaign at Donlin in probably 15 years. We drilled about 45,000 meters, and we have released about a third of the results about a month ago, and we anticipate releasing another third of the results later in October, and the balance earlier in the new year. This drill campaign was part of a $60 million budget at Donlin this year, 30 to Novagold and 30 to our partner. In addition to the drilling, which was the lion's share of the expenditures this year, we also continue to be actively engaged in the communities in and around the Donlin Gold project. Of course, lobbying and other, stakeholder outreach. But that 60 million is, I think, is a real indicator of the owner's commitment to the project.
And Greg, maybe you can just tell us why you've been so aggressive with the drilling. 24,000 meters last year. You said, did you say 40,000 this year?
Yes, over 40,000 this year. Yeah, we've the focus of the drill programs for the last 2 years. Part of it is our partners. Barrick has been our partner for many years, but the executive team at Barrick is all essentially Rand Gold people that joined the company with the merger a couple of years ago. A lot of the drilling, particularly in 2021, was largely part of their due diligence and their desire to get a better understanding of the geology and the structural controls on mineralization. And I think we've certainly accomplished those objectives. The program this year, which was substantially larger than last year, had similar objectives, but also we did some drilling deep below the known deposits, ACMA and Lewis, as well as along strike and on trend. We also did some drilling, some very tight spaced drilling to verify the short-term continuity of the mineralization and particularly the high-grade intercepts that we periodically encounter through our drilling. And I think, as you've seen from our earlier results, some really fantastic intervals, some of the best in the industry this year.
And are they still drilling right now? And will they continue drilling throughout the winter?
We started our drill program in February. There are certain areas of the deposit that are better drilled when the ground is frozen. So we started in February. We, achieved really good drill productivities. We were very satisfied with the drillers and the support staff that we had. So we were able to largely wrap up our drill program in September. We're finishing up a few holes and we're doing some geotechnical drilling, but we expect to have the camp shut down sometime in October, and we'll reopen it again in the new year.
A phrase that I've heard you say, and I thought was quite interesting, and I want you to expand on this, but you've said that the next Donlin can be found at Donlin. What do you mean by that exactly?
Well, I think that, that phrase really speaks to the exploration potential that we see at Donlin. And the potential is in several areas. The known deposits at Donlin, which we refer to as ACMA and Lewis, occupy about 3 kilometers of an 8-kilometer gold-bearing system. And throughout this gold-bearing system, we've got ore grade intervals all up and down the strike. And also, as we tested this year, there's areas below the deposit where it's open-ended and areas of sparse drilling inside of the boundaries of the known pits. So we've done some drilling there, and we look forward to updating the market with these results in the coming months.
Greg, just to clarify, most of the drilling or all of the drilling has been done on the Donlin gold deposit. Have you done any drilling outside of that?
No, we have not at this stage, Jimmy. We focused our drilling in and around the known ore bodies because that's where we see we can add potential value to the planned open pits as opposed to developing a new pit along strike. Our drilling this year has been some below the depths of the known mineralization and some into areas of the deposits that were sparsely drilled in the past that we think there's the potential to convert some of the waste to mineralization or to ore. So we're really focused right now on drilling that can add value to the currently planned open pits.
Greg, an element which contributes to the success of any endeavor is partnerships, and I want to expand on these partnerships that Novagold has, beginning with the Alaska Native Corporation. Can you just expand on the relationship that you have?
Sure. The land that the Donlin deposits are situated on is owned by 2 Alaska Native corporations. Calista owns the mineral estate, and TKC, or the Kuskokwim Corporation, owns the surface rights. And we have life of mine agreements in place with both of these native corporations, and they've been staunch advocates for the project as we've navigated the permitting, great allies to have. And they've made significant contributions to our planning as well as our lobbying efforts in Washington, D.C. They're fantastic partners, and we're fortunate to be on private land. And that has, I think, simplified the permitting in some ways for us. And our native corporation partners, they have an owner's interest in seeing this project go forward. Donlin is located in one of the most impoverished regions of the United States, and there's no real economic opportunities on the immediate horizon other than the Donlin Gold Project. So they'd certainly like to see the owners make a construction decision and move forward with the project. Our other key partnership is Barrick. Many companies like Novagold that are junior companies are looking to partner with major producers. And we're fortunate to have one of the largest gold producers as our partner. Dr. Bristow and his team are very geologic focused, and they've certainly brought a lot of value and fresh thinking to the Donlin project.
And I'm glad you brought up Barrick, because once again, you mentioned this earlier, but it is a 50-50 joint venture. But how active are they? Like, were they at the site all summer, and do they determine where you drill and how much you drill?
Yeah, our partner has, particularly since the merger with Randgold, Barrick has been very involved with the project. Earlier in September, I spent a week at site with Dr. Bristow and about a dozen members of his senior staff. They've been very involved in all aspects of the project, with a primary focus on the geology. As we're increasing our understanding of the geology, we're working with our partner to bring them up to date on the engineering and the various studies that have been conducted at Donlin over the years. They've been reviewing all aspects of the project, from the hydrology, the permitting, the metallurgy, and so on, just as they've, the new team has gotten their level of understanding increasing on the asset.
And of course, another very important partnership is with the government, both at the state and the federal level. Maybe you can just expand on that. And then from that, also tell us about the permitting and if there are any outstanding permits.
Well, the state of Alaska, it's a resource-driven economy, primarily because of the petroleum resources on the North Slope. And it's a state that has always valued responsible natural resource development. Alaska is the second largest gold producing state in the US. And there's, many companies have been successfully operating there for many years. Kinross, Hecla, Coeur, as well as Teck and others have all been active in Alaska for many years. And it's a state that understands mining. They appreciate the contribution mining makes to the economy. And they've been staunch allies for us as we've advanced the project through the federal permitting. On the permitting side, we have wrapped up the federal permitting. Several years ago, we received a joint record of decision from the Army Corps of Engineers and the Bureau of Land Management. Along with this, we also received our wetlands permit, the 404 permit. And these permits authorize the activities at the site to commence. We were mainly focused on the federal permits, but we've also been working our way through the state permits, and have we received air quality, water quality, and all the numerous state permits that mirror some of the federal permits. The only outstanding state permit is for the tailings dam. And this is a permit under the state of Alaska that requires detailed geotechnical and final engineering drawings for it to be authorized. And this season, we started the geotechnical drilling, and we, can certainly conclude that permit, while we're doing other technical work. And the 404 permit actually authorizes us to build a tailings dam, but in Alaska, water retention structures, tailing structures, and the like are administered by the state, hence another layer of approval. But the state has been very responsive in processing our permits, and we have a great working relationship with them.
So that's a great overview of your partnerships and also the permitting process. Let's move on. I want to touch on your balance sheet, because you do have a very aggressive drilling campaign that's going on. That's going to require a lot of capital. So how much cash do you have on the balance sheet, and how will you allocate it in the coming year?
Well, at the end of last quarter, we had a treasury of over $140 million. Next year, we have another $25 million coming in from Newmont, which is the final committed payment relative to the sale of our Galore Creek project to them a few years ago. So we've got a strong balance sheet this year, including our expenditures at Donlin, as well as our corporate and overhead expenses are in the mid $40 million range. And you can look at our balance sheet, and we could continue at that current burn rate for many years. So I see no reason for us to go to the markets and raise any money, at least for a few years, until we're ready to move forward with the construction at Donlin.
Another element that really stands out to me when I was going through your marketing deck is your shareholder base. You have a very strong shareholder base, some of the best institutions in the world, including Fidelity and BlackRock. And the other one that really stood out was the Saudi Public Investment Fund. Maybe you can just touch on them, because that's not a name that I see too often.
Sure. We were introduced to the Saudis about 4 years ago, when they had approached us and said, hey, when it comes time to raise money, we'd like to participate in the project financing. And the representatives from the Public Investment Fund conducted very extensive due diligence on Novagold, the management team, the asset, and and our response was, well, we don't need to raise money for several years. And they, instead of participating in the finance, they came into the story as a major shareholder. And we're fortunate, as you mentioned, our other shareholders, Fidelity, Paulson, BlackRock, First Eagle, many of them have been shareholders for a long time. And about 2/3 of our outstanding stock is with the top 10 shareholders, and they're long-term, very sticky money. They see the value in an asset like Donlin, and some of them look at us as an unexpiring warrant on an ounce of gold. But it's great to have a shareholder base like that, as we've all navigated the turbulent markets of the last year.
Greg, as we wrap up, what can investors expect in terms of news flow from Novagold in the coming months?
Well, the most important news that we'll have coming out later this year is the next third of the assay results from our drill campaign this year. And that'll be an important bit of news. Also, typically we guide the marketplace around year end on our work programs and budgets for the following year. And I think that'll be news that'll be expected and delivered in the normal course of our business.
Well, Greg, that was a great overview and a great update on Novagold, and I want to thank you for spending time with us today, and we are looking forward to those drilling results. Once again, thank you.
Our pleasure, Jimmy, and thank you for reaching out and having us on your forum today.
Jose, thank you very much for joining us today. How are things in Toronto?
Fantastic. Thank you very much for having us. It's a real pleasure to be with you.
Jose, O3 Mining recently released a pre-feasibility study on its flagship property, Marban. And before we examine that in detail, why don't we just start with a brief introduction of O3 Mining for those viewers who might not be familiar with the company?
Absolutely. O3 Mining is a multi-million ounce gold deposit located in Val d'Or, which means the Valley of Gold, no wonder why, located 12 kilometers from the Canadian Malartic mine, the most important gold producer in Canada.
And if I was going to drive to Val d'Or from Toronto or Montreal, how long would it take?
Approximately 6 hours from Toronto, I would say. From Montreal, around 3 to 4.
And for those who aren't familiar with the town of Val d'Or, as you said, there's a number of gold mines around that region. So you're close to highways, it has electricity, you have a labor force.
Yeah, it's a prime place to be. Val d'Or is a place, again, is the Golden Valley or the Valley of Gold, where more than 40 million ounces has already been produced. New ounces have been found every other year, pretty much. Over 20 million ounces has just been discovered in the past 15 years, although has been a very mature camp. And as you well mentioned, I mean, that's not the only important part. Well, certainly it's very important to have the gold there, but there is highways, there is railroads, there is an airport, there is water, there is energy, cheap energy, clean energy, it's hydroelectric energy, and manpower, which is extremely important for what we do, no? Because our job is a very scientific job, as you can imagine, on the not only on the geological front, but on the mining side of things.
So let's jump into the pre-feasibility study now on Marban. Take us through the highlights, touching on the net present value, the internal rate of return, CapEx, and also the payback.
So very important to mention here what a pre-feasibility means is a report that is being made with the most valuable amount of ounces. What I mean by that is we usually have a resource which is not very well structured. That's called the inferred resources. That means that you have been drilling every 100 meters, let's say. Then you go into the next level where you drill every 40 meters. That's what indicated means. And then measured, where you drill it only every 15 meters. The pre-feasibility study encompasses only the measured and indicated resources. So the quality of that report is very important, and it has a different level than any other studies. We have done that study, and that is showing us a net present value of $463 million. What the net present value means is that essentially you are taking into account the interest rates, and you're bringing all that money that is in the future, in the next 10 years, to today's money, because today's money is more expensive or is more valuable than tomorrow's money. So it is very important to do that exercise. And then our internal rate of return is around 23%. What the internal rate of return means is the interest rate taken up to the maximum, to the point where the net present value equals 0. That means that, is the project okay if we use 7% discount rate? Is the project okay if we use 8% discount rate? This project is worth, even though if you use 23%, at that moment you don't make money. Now, this is 23% unlevered, which means that you have not taken debt. So if we go back to the bank and the bank actually give us money, which there is no reason why they would not give it to us, since we're using the highest level of measured and indicated in terms of resources, that means that they could be lending us the money. If we use now that for a new internal rate of return, our values are more in the order of 40%. So this really shows how robust is this project, only as a standalone project. Never mind if you want to start elucubrating what would happen if, or how much would this represent to Canadian Malartic, which is a joint venture between Yamana Gold, which is now being taken over by Goldfields, and Agnico Eagle, which now is one of the largest and most important gold producers in the world.
One other element I want to touch on, Jose, that came out in the pre-feasibility study is the all-in sustaining cost. And I was surprised to see it below $900 an ounce. Maybe you can just touch on that and also explain how you were able to come in with such a low number, especially in this inflationary environment.
Yeah, so the all-in sustaining cost really takes into account all the costs: mining costs, labor costs, G&A, facilities, all the industrial part of things, and yes, we are below $900 per ounce. The rationale for that is the amount of facilities that we have in Val-d'Or. We don't have to build a lot of roads. We have the energy right there. We have the manpower right there, and that allows us to bring the cost down. At the same time, we have to have in mind that we will be producing 6 million tons of ore per year, which means that we will be processing around 15,000 tons per day, which in the big scheme of things, you know, the amount matters. So critical mass is important, and as part of that, we were able to have this very competitive cost.
And why don't you just put that into perspective for us? How many ounces a year would that be, and what is the life of mine?
That's very important to mention, and thank you for bringing it up. Our pre-feasibility study is considering 160,000 ounces of gold per year for 9.5 years. And why is that important? Because if we assume that, say for the sake of the argument, we make $1,000 out of gold, we will be in the order of $1.6 billion in terms of revenue, which by any comparison, this should mean that the company is worth at any given time in the order of, if we take 2% of that, $320 million.
And just to clarify, the numbers we just reviewed in the pre-feasibility study, it's all based on $1,700 gold?
Yes, correct. We are using $1,700 gold. The rationale for using $1,700 gold is that in the benchmark we did with the Canadian banks, the average gold price was $1,750, so we decided to use $1,700. This study is robust as a rock. We used for oil prices even higher prices and benchmark, just to be conservative and to try to back a little bit the inflation in this current markets. No?
And of course, if you use higher gold prices, 1,800, 1,900, the economics are going to be significantly better.
Correct. And if we use $2,000 gold, we're rocket sky. You know, it's $900 million net present value. And one thing that probably is important to mention, and the opportunity for your viewers and for new investors, is that this company right now is worth $100 million Canadian. We have already invested. We have already raised the money. We have already put it into the ground, which has been transformed into a pre-feasibility study, $70 million. And we have right now, as we speak, another $70 million in the bank between the equities that we have in a company called Moneta, which is another multi-million ounce deposit in Ontario, and the cash that we have. So really the opportunity here is very unique, because without taking the study that has just been announced and where it shows fundamental value of over $400 million, actually closer to 500, the company right now is pretty much trading at a discount from cash for practical purposes.
And Jose, now that you've completed the pre-feas, what are the next steps?
We're going to move towards a feasibility study. We expect to have the feasibility study by the third quarter of next year. And not less important, we're planning to put out a new resource by the second quarter of next year with regards to Marban. Most of those ounces in inferred resources. And why we want to do that is because we want everyone to understand that this project, as we speak, in this pre-feasibility study with 9.5 years, $463 million net present value, is only the base part. Like, these are the foundations. On top of this, we'll keep building. So we expect to at least extend with a new resource of next year, say 3 years to 4 years mine life. If we do that, for every 160,000 new ounces that we incorporate to the project, that represents in the order of $80 to $100 million net present value, depending on different metrics that we use. So that is very important. We could be increasing in $300 to $400 million the net present value only by adding these new ounces into our story, which is extremely important.
Very good points. And so I want to move the conversation now toward exploration. Are you going to continue to explore at Marvin and also at your other property, Alpha?
No, I think this is the moment to be very cautious on capital allocation. Our job as executives on a junior mining company, we do depend on the market. We raised recently, only a couple months ago, $18 million, and that goes immediately or most of the money into Marvin, where we believe we can, again, add these new years of mine life, which would impact immediately into our fundamental value of the company. And we will use some money, say a 20% of that, into new areas within Marvin to look for a new discovery as well.
So that's another great segue to my next question. Now that you just talked about fiscal responsibility, I want to talk about your balance sheet. You mentioned earlier that you just did a raise for $18 million. So you now have $25 million in cash on your balance sheet. How will you allocate that in the coming year?
Yeah, all the money will go, or 90% of that will go into Marvin in order to finalize the feasibility study. And the whole intention of our team is essentially with the feasibility study to have the project finance. So we will announce a feasibility study, hopefully with a financing for the whole project. So that way we will essentially make sure that everyone understands that we're not playing here to do different studies, but we are actually going to build the next most important mine in Canada, in one of the most important jurisdictions in the world.
So in addition to having $25 million in cash, you're also sitting on some securities, one of which is Moneta Gold. Can you just touch on that and what your aspirations are for this investment?
Yeah, so one of the things that we did has been spinning out different assets that fits better into other corporations. That was part of our work with Garrison, that now it's sitting in Moneta Gold. Moneta has over 11 million ounces. We contributed with 3 million ounces out of that. They have put out their own preliminary economic assessment, which shows almost like $1 billion in terms of fundamental value, which allocated to us will be around $250 million. Right now, those equities are in the order of $40 million. So we have an opportunity to re-rate there and to maximize value for shareholders. And we also did the same thing with Cartier Resources, which is seated on the eastern side of our property. We believe that that property within Cartier Resources, where we have 18%, will be more valuable since they already have over 2 million ounces in resources. And with our property, they could be showing a much more amount of ounces, or a multi-million ounce deposit altogether, which will be adding more value to shareholders as well.
So let's move the discussion toward valuation now. You touched on this a little bit earlier, but O3 Mining offers tremendous value here. Your market cap is at 100 million, but in the net present value on Marvin is over 400 million. You have investments in various companies that you just discussed for $50 million, and you're sitting on $25 million in cash. There's a lot of value here. What will you and your team do in the coming months to unlock this value?
So I think in our case, we have to focus on where we can deliver. I mean, the market will do what the market does. But our job is essentially to keep adding value and to keep reducing risk at the project level. And that's what we will do by moving our studies from a pre-feasibility study to a feasibility study. But on top of that, our job is to really show that this project is much better than what you can see in the study. And that is what we can do by augmenting the amount of resources, even if it's on an inferred category, because that just means that if you drill more in the center, you go from 100 meters to 50 meters, or from 70 meters to 35 meters between two holes, and then that will go into the next study or into the mine life. because at the end, once you start mining this, you will continue to do exploration. Now you know that this can last not 10 years, but 15 years. Now you're talking about an asset that on the fundamental basis is worth over $700 million, which is extremely important because when the market reacts, because the market will react, this is cyclical, we will be in a very good position. You know, this has happened plenty of times. So next year, at the beginning of the year, hopefully we will have another gold rally. And what will happen is either we will be building this, or a major company may say, well, we want to take it over, and or what can they take over? And the reality is that there is very few projects right now in the market that has already a pre-feasibility study, less a feasibility study, and even less a project which is already permitted.
And are you concerned that a major or a producer recognizes the value in your company as it is right now, and they come in and make a bid for your company?
It concerns us, but just a little, in the sense that most of our shareholders, I don't think, will sell at these prices. But of course, if we go to $2, and then that is a much more complicated situation, because then some of the shareholders will be making money at those levels if we get a premium from them. So we have to make sure that, again, we do what we have to do, which is advance the project, de-risk the project, and for that we will be gaining the prize. No?
You were recently at the Precious Metals Conference in Beaver Creek, Colorado. What feedback did you hear? Maybe you can give us some color on the conference. What was the mood like?
I mean, I don't think the sentiment was the best sentiment in the world, although there is hope. And I guess everyone agrees that, you know, by the end of the year or first quarter next year will be a turning point for the gold market for different reasons, increasing the hiking rates. You know, governments may have to bring it down again in order to, you know, get the economy accelerating. And as you do that, more likely we will see a change in gold price. And the other thing that was very clear is the amount of major companies at the conference, and that only shows that, you know, the majors are actually right now looking, and there will be a bunch of M&A transactions. We have seen now Gold Fields taking over Yamana, and I would imagine that this is going to be like a snowball. There was a lot of, you know, gossips there on other companies being taken over. It will be very interesting to see how these markets turn around.
Jose, as we wrap up, you've mentioned that you have a lot going on at O3 Mining in the next few months, but maybe you can just summarize for our viewers on what they can expect in terms of news flow in the coming months.
Absolutely. So once again, as fundamental value right now, O3 Mining is worth $463 million based on only Marban. We have cash and we have our equities, and that is worth another $70 million. So as you can see, there is a lot of money already here to be made only on the basis of Marban. On top of that, we're working on the exploration, where we intend to have a new resource for the first quarter or second quarter of next year, which will be adding value into this pre-feasibility study. And we are going to put the cherry on top of the pie by July next year, sorry, more towards September next year, 2023, where we're going to finalize our feasibility study. And with that, we would have de-risked completely the studies and the project at Marban, and move towards permitting and construction.
Jose, thank you very much for spending time with us today. That was a great overview and a great update on O3 Mining. And once again, I want to thank you.
Thank you very much for your time, Jimmy. This has been fantastic.
Hi, I hope you're enjoying the conference. Did you know 80% of our viewers are not subscribers to our channel? So please subscribe to our channel and help me feed my family. Thanks for your support. Hi, Simon. Thank you very much for joining us today. How are things in Perth?
Yeah, beautiful. Thanks, James. weather's just turned for the nice time of the year, but no, it's a real pleasure to be here today to discuss Northern Star Resources with you.
So we're heading into fall, and I guess you're heading into spring.
Correct. Coming out of a fairly wet winter, so yeah, the weather's looking up, and yeah, things are good over here.
Simon, Northern Star is one of the largest gold producers in the world, but many investors in North America are not familiar with the company. So before we do a deep dive on your assets, why don't you provide us with a brief overview of Northern Star? Tell us, where's the company based? How many producing mines do they have? And also, what is your annual production?
Yeah, no problems, James. Look, to start with Northern Star, the best way to think of it is it's a simple business. We're an ASX listed gold company. We've got assets in tier 1 jurisdictions of Australia and Alaska. And we've got 3 main production centres. So Kalgoorlie, Yandal in Western Australia here, and then we've got Pogo in Alaska. But our real purpose is to generate superior returns for our shareholders by being a responsible producer, really having profitable growth and not growth for just growth's sake. And we certainly have world-class assets, which puts us as a top 10 global gold producer.
And Simon, what would be your annual production?
In the last 12 months, we produced 1.56 million ounces of gold production at an Australian all-in sustaining cost of $1,633 an ounce. So a significant production profile that, as we can get into later on, is continuing to grow as we deliver into our 5-year strategy.
Simon, one of the elements that makes a mine truly successful is scale, and you certainly have that at Kalgoorlie, which is your flagship property. And when I say flagship, I'm probably understating it here because this truly is an exceptional mine. And I want to put this into context for our viewers. This area has a very rich history. It's been producing gold since 1893. It's already produced over 65 million ounces. So that's a good backdrop for our viewers. Why don't you provide some more detail on this area?
Yeah, look, Kalgoorlie is a fantastic place to be mining gold. In the last 12 months for our operations in Kalgoorlie, we delivered 903,000 ounces of gold and an Australian all-in sustaining cost of $1,624 an ounce. And that's going to continue to grow to 1.1 million ounces from the Kalgoorlie region only over the next 4 years up to FY26. So yeah, it's a very, very exciting area. KCGM is the centerpiece of our Kalgoorlie production center. A lot of people around the world would have heard of KCGM, but it's very, very exciting that in the first time in its history, in 31 years, it's under one company's ownership. Previously, it was a joint venture established in 1989, but now it's under one ownership, which really simplifies that business and enables the Northern Star to make the right decisions for that asset. Hence, you're seeing it continue to grow, James.
You currently have a 3-phase optimization program at KCGM. Why don't you just tell us about this and exactly what it entails?
Yeah, so in the last 12 months, a key part of reinvigorating and growing KCGM under one ownership was replace the equipment fleet there, which we had 39 new trucks, which is a huge amount of equipment come in and to commission. So we've completed all of that delivery of the equipment. It's all been commissioned, and now we're really starting to see the benefits of that, which is the optimization phase over the next couple of years. So that's a key step for us, which is now behind us, and we get the fruits of the lower cost going forward and increased material movements. So the fleet was the first piece. We are increasing our material movement at a big pit that's going to ultimately end up 3.8 kilometres long, 1.5 kilometres wide, and 800 metres deep. So it's an impressive operation on a world scale, which is fantastic that we own it. But we've got the fleet replacement we've completed. We are optimising the Fimiston South area, which is just the southern end of the pit, and that we're going to be mining in there for the next 15 to 17 years at this point. So there's plenty of optimisation work as to how we mine over the next 1 to 2 decades. And the last piece of the optimisation really is Golden Pike is the main ore body in the base of the pit, which is a lot of ounces. One area alone is 1.2 million ounces in the base of the pit. Very high grade and very low cost. So they're the 3 areas that we're really pushing at KCGM, which over the next 4 years will see us grow that production profile from 900,000 ounces last year up to 1.1 million ounces by FY26.
And when you say that the pit is almost 4 kilometers long and 800 meters deep, like, you got to see this thing to realize how big it is. But I'm just kind of curious, how long would it take you to drive to the bottom of that pit?
Yeah, if we typically have a truck driving out, trucks go a lot slower than the light vehicles, but it might take you 30 minutes to sort of drive out of the base of the pit to the top. So we've got production centres at the top of the pit, on the east side and in the base of the pit. So it's a real optimisation that we work through.
So that's a great overview of your flagship. Let's move on to your second production centre. It's called Yandal. It's also based in Western Australia. Just provide us with an overview of this production. How many ounces does it produce, and what is the all-in sustaining cost?
So Yandal is about, call it 300 kilometres north of Kalgoorlie. So they are reasonably close for Australian standards, but we treat them as 2 different production centres. But in the last 12 months in FY22, the Yandal Production Centre delivered 443,000 ounces of gold at an Australian all-in sustaining cost of $1,430 an ounce. So this area, a bit like Kalgoorlie, is continuing to grow as well. So we're going to grow from that 440,000 ounces up to 600,000 ounces over the next few years, and we've guided in the next 12 months to 480 to 520,000 ounces at an all-in sustaining cost of $1,525 an ounce to $1,625 an ounce. The key areas for Yandal that is driving that production growth up to 600,000 ounces really is around a mill expansion that very pleasingly we've completed. We've completed over 90% of that in the last 12 months, and going forward we'll be commissioning the big mill to take us from 3 million tonnes to 6 million tonnes throughput and really drive the next level of gold production in the Yandal Production Centre.
So let's move on and touch on your last producing mine, and that's called Pogo. It's based in Alaska, and Northern Star acquired this in 2018 from Sumitomo. Can you provide an overview of Pogo, just touching on the annual production and also the all-in sustaining cost?
Yeah, so Pogo is obviously a little closer to where you are, but up in Alaska for us. So it's based on the Tintina mineral belt, which some of your viewers might know about. But it's about 60 kilometres northeast of Delta Junction and about 140 kilometres southeast of Fairbanks. So this operation we purchased 2018, so 4 years ago, and what we've seen over that time is really growing the resource and the reserve. So the resource at Pogo is over 7 million ounces and an impressive 10 grams per tonne. So a very high grade deposit. We see a 7-year plus mine life at Pogo. and we've been investing heavily over the last few years, really rebuilding the mine, and now we're getting into that optimization phase.
And Simon, what is the annual production at Pogo, and where do you see the growth going in the next couple of years?
So Pogo delivered 214,000 ounces of gold in FY22, and we've guided to a next step up increased production of 260 to 290,000 ounces over the next 12 months. So really, Pogo continues to grow towards 300,000 ounces a year. We've got a next step up in the next 12 months, close to that. But really, it's the delivery of Pogo is around the mill expansion, which we've just completed. So we've got the ability to process more ore, which will give us higher volumes of gold output over the next 12 months. So continuing to optimize and grow Pogo, which you'll also see in sort of growth in returns back to shareholders as well.
And so you have a lot going on at Kalgoorlie and also at Yandal and at Pogo. So that's going to bring us into your balance sheet because, of course, you got to finance all of these mines. But maybe you can just give us an overview of your balance sheet. How much cash do you currently have, and how are you going to allocate cash in the coming year between the various mines and your CapEx and also your dividend policy?
Yeah, sure. So the balance sheet for Northern Star is in a great position. We're in a really enviable position. We've got a net cash of $528 million. We've got $100 million of corporate debt. And last year we generated over $1 billion in cash earnings. So significant cash flow generations from the three production centres. Primarily driven from 90% of our earnings came from Kalgoorlie and Yandal, but Pogo will continue as those ounces grow. You'll start to see a higher contribution from Pogo going forward. So $1.5 billion in liquidity. So we're in a great position to internally fund all of our growth projects, as well as continue to pay dividends to our shareholders going forward. If I touch on our capital efficiency, it's a real key focus, James, for Northern Star. So our 5-year average sees us 20% return on equity, which ranks us #1 against our global gold peers, which is an amazing performance historically in the last 5 years, and we really have set the business up to continue to deliver over the next journey. So shareholder return 66%, ranked third against our global peers, and return on invested capital is 11%, which is still ranked in the top 10 against our global gold peers. So we are in a fantastic position in terms of our balance sheet at Northern Star.
So I want to move the discussion toward M&A now. In addition to Northern Star acquiring a North American asset, there's been other Australian companies acquiring other North American assets. Just earlier this year, we had Newcrest purchase Pretium in British Columbia. Do you see this as a trend that's going to continue with the Australian miners coming into North America and acquiring assets?
Yeah, certainly seems to be a bit of a trend. Maybe some of it kicked off in 2018 when Northern Star actually acquired its first international project at Pogo. We see we've got some advantages of how we look at ore bodies. Some of the more difficult ore bodies we can bring different techniques to. In terms of Australians heading to North America, we see Pogo and our learning experiences that we've gained over the last 4 years puts us in a really good position to treat our Pogo operation and our learning experiences as really a beachhead into North America for potential other operations, and take our know-how that we've introduced into the Pogo mine successfully broader into the North American operations. We also have our Northern Star Mining Services, which is an internal contracting division, which is located within Northern Star, which really focuses on underground mining excellence. And we continue to see that as a real opportunity for us to unlock value on some of the assets, Pogo and others in the North American space. So yes, it will be interesting to see what happens over time, but right now we're very focused on Pogo and delivering up to our 300,000 ounces, but we've got some fantastic learnings over the last 4 years.
So can we assume that Northern Star would look at other North American assets under the right circumstances?
I think we're always looking. So yes, we can continue to keep an eye on what's available, and if it makes sense for our shareholders and for us as a business, then we'll continue to look at opportunities in North America. But we certainly are very focused on tier 1 jurisdictions, so that fits in within our strategy. Northern
Star currently trades on the Australian stock market and also on the OTC market in the US. Would you consider getting a listing on the TSX or on the NYSE to get more exposure to North American investors?
I think it's something that we'll always continue to look at. Most of our earnings are from the Australian operations at this point in time, so it makes sense for us to be ASX listed. But as we potentially grow more into North America, it's something that the board will continue to look at. Does it make sense? How do we get more North American shareholders exposure to the Northern Star stock and story? So it is something that we'll continue to look at. There's no plans to do it right now, but for sure we'll look at it as our operations continue to grow and diversify over time.
Simon, as we wrap up, what can investors expect in terms of news flow from Northern Star in the coming months?
So coming up on the 19th of October, we've got our quarterly Q1 for FY23 results. So we'll deliver that. That's our next news flow on the results of Q1. Then we've really got a KCGM mill expansion coming up, a decision point around that. So it's an additional growth to our 5-year strategy that we're assessing at our biggest production centre. So potential mill expansions there. So over the second half or early 2023, we'll make a decision around do we see good value in that to go forward with our mill expansion. But really it's quarterly updates. The next major news flow is early 2023, a big decision point around KCGM mill expansion, which is pretty exciting to work through.
Well, we look forward to that news. Simon, that was a great overview and a great introduction to Northern Star, and I want to thank you for making time for us today.
Thanks, James. If I could just finish with a summary around Northern Star. So we've got a clearly defined 5-year strategy. We are a responsible producer. We've set guidance for the next 12 months, FY23 at 1.56 to 1.68 million ounces. So continue to grow at an impressive Australian all-in sustaining cost of $1,630 an ounce to $1,680 an ounce. We've got very strong cash flow generations of over $1 billion in the last 12 months. And we've got world-class assets we're extremely proud about and are generating superior returns, which is our absolute purpose and focus at Northern Star. But thanks for the opportunity, James, today to tell you about the Northern Star story.
Simon, thank you. That was a great overview and a great introduction to the Northern Star story, and we do appreciate it. Thank you for making time for us today.
Much appreciated, James.
Hi, Joe. Thank you very much for joining us today. How are things in London?
Hi, Jimmy. Yeah, London's good, thanks. Summer's been a bit quiet, but we're looking forward to a better end of the year.
That makes two of us. Joe, you're a portfolio manager for the Gold and Silver Fund at Jupiter Asset Management. And before we do a deep dive on the gold and silver sector, why don't you just provide us with a brief overview of Jupiter Asset Management? Where is the firm based and what is the firm's AUM?
Well, we're based in London, and the AUM is hovering around about £50 billion at the moment. We've been a small firm that's grown organically. We're about 35 years old. Yeah, we primarily have a range of funds that are pretty much directed towards the UK market.
And because you're a portfolio manager for the Gold and Silver Fund, that's what we're going to be focusing on in this discussion. What is the AUM of that fund?
At the moment, the AUM is around about $700 million, or we could probably say at the moment 700 million pounds as well.
And can you just provide makeup of the fund? How many names does the fund own, and what would be the breakdown between producers, developers, and explorers?
Yeah, we have a 45 stock portfolio, and at the moment, only 12 of those 45 are producing mining companies in production. At the moment, we are looking for, if you like, a safe haven in the high quality development space. And we also have 20% of the fund in gold and silver bullion funds. That's the spot products, if you like, not the ETFs because of custody issues. And the average market cap, I think, would be around about $3 billion.
And does the fund have any restrictions on jurisdiction? Are there any countries in which you cannot invest?
Yes, our mandate restricts us to only investing in the Americas and Australia. And I think that's with what's happened with Russia over the last few months. We didn't have any exposure there, so I think our rationale has been borne out. The reason why we do this is because the market doesn't seem to give us any pricing differential for owning a company that operates mining in Africa. We could buy Northern Star Resources in Australia for 0.7 times NAV, and we could buy B2 Gold in Africa for 0.7 times NAV. They have radically different operating risks environments, and yet the market doesn't differentiate between them. So we understand, that there's less risk in operating in the Americas and Australia.
And what about market cap? Do you have any restrictions there, or is there a minimum market cap in which you can invest?
In theory, no, but obviously, there are liquidity concerns, and the lower the market cap, the more. If you go into the exploration side of things, you need to be your conviction has to be pretty high. About 3% of the fund has a market cap of less than 100 million US. So that should give you an idea, hopefully, of how we see things. We're a daily trading UCITS 4 fund, and liquidity is one of the big things for us.
Joe, that's a great overview of Jupiter Asset Management, and also your funds. I want to move the discussion now toward valuation, and I want to determine the valuation of the sector now and how it compares to past cycles. But before we do that, let's first discuss how you and your team value gold equities. Do you look at earnings, cash flow, or do you look at net asset value?
We run a bottom-up process. We build and run our own models in Excel, and we update the models, refresh them every day using Bloomberg live pricing, and then we upload the results of that to Bloomberg, where we can view it in a live situation, if you like. So we look at NAV, net asset value, of course, and also cash flows. I mean, primarily we're discounting cash flows on a 5% discount rate, and we're using the forward curve every day. So we're basically refreshing the valuations on a daily basis.
And what gold and silver price do you use to value equities?
Well, this is the thing. We use the forward curve, and that's refreshed on a daily basis. So we're not actually using a constant spot price. So that helps us because it gives us the flavour of what the market is looking at, a few years out. And if we take the forward curve beyond year 3 or 4, the price usually is higher. So we then we use that price flat across the remainder of the mine plan. And that gives us a pretty good idea. If we use that constantly across all the models, we can get a good relative valuation.
And how does the current valuation of the gold sector compare to past cycles?
Well, Jimmy, it's never been lower than this. I think the key stop for us is, as for many, is Agnico Eagle. So before it took over Kirkland Lake, it was trading on about 2.2 times NAV. When the dust settled after the Kirkland Lake acquisition, it was trading on 1.6 times NAV, and now it's trading on 1.3 times NAV. And you could argue that Agnico do it in Canada better than anyone else, so they deserve that premium. But right now, I think the NAV multiples have collapsed. You've got the Australian miners like Northern Star trading on 0.7 times NAV, and 12 months ago they were on 1.4 times. Over to the developers, I think the market's really differentiated between the quality projects like Center Grey and Cisco that are our mines. They're trading on around 0.4, 0.5 times NAV. But then you've got a whole load of other stuff. I'm going to say Seabridge, which is a monster that needs billions of dollars to build it. That's trading on 0.2 times NAV. And there's a lot of stuff out there, where there's a question mark on financing that is trading around about 0.2 times NAV. And I think the market, we always look at these explorers and developers as call options on the underlying. That's how we value them. And at the moment, it almost feels with the lower quality end of the spectrum, the market's kind of given up trying to value these things. They're just saying it's 0.2 times NAV, and that will be until we get a different market.
Joe, you just provided some great examples of where valuations are now compared to previous cycles. And I guess my next question is, why are the valuations in this cycle so much cheaper, especially given the strength of their balance sheets? They have little or no debt. They're cash flowing millions of dollars. They're paying out very attractive dividends. Why are the valuations so cheap in this cycle?
Yeah, that's a good question, Jimmy. The reason we think is the reason why we only own 12 producing stocks in the portfolio of 45 stocks. The operating environment of these mining companies has never been labour issues, absenteeism. We've also got in Australia significant wage inflation and labour availability. You've also got the uncertain cost of raw materials. Steel balls, for example, are going up in double-digit numbers in inflationary terms. So there's a lot of uncertainty in the operating environment, and I think this is one of the reasons why the market is decided to ultimately what we're trying to do here is to value risk, and the market is basically saying to us that the operating environment of these producers is very high right now. And there is not a lot of visibility, which is why you're seeing these cash flow multiples are lower than you would normally see historically.
You raise a very good point there about the challenging environment that we find ourselves in, and also inflation. And I guess we saw these elements in Newmont's second quarter. The stock was up 20% on the year earlier this year, and now it's down 30% on the year. Can you speak to that at all?
One of the stocks we don't hold in the portfolio is Newmont. And the reason why is, one, because they have exposure outside of the Americas and Australia. And two, if we need liquidity, we buy and sell the positions in the bullion funds. That means that we don't actually have to hold the larger cap miners. We can, the majority of our operating miners of Agnico Eagle is the largest, are in that kind of sweet spot developer space where you are looking for the bigger miners essentially to acquire them over time as their reserve depletion starts to gather momentum. So we've had successes with Pretium Resources, for example. that was one that we held, and there have been others as well.
And you touched on Agnico's acquisition of Kirkland Lake, which I believe closed earlier this year. We also saw Newcrest come in and buy Pretium.
Yeah.
There seems to be a lot more M&A. What are your thoughts on this? Is this a good time for these seniors to come in and buy smaller producers?
Well, I think so. But anyone holding the quality developers is well aware that they're cheap, and I think they're trying to let's just say puff themselves up to be as big as possible. I know that some companies are reluctant to open their data rooms at the moment because they don't want people pouring over their books when these asset values are just so cheap, and we understand that.
And we're seeing more and more headlines from gold producers stating that they want to increase their copper exposure. What are your thoughts on this?
Well, I mean, I think it's not new. 15 years ago, you were getting noise about how Barrick bought Lumwana in Zambia, and there was a lot of controversy about that. You've now got Barrick talking about the Reade porphyry in Pakistan, which is one of the more colourful regions of the world to put several $1 billion, let's say. I think that yes, with reserve depletion and growth required, I think there is an argument to say that this is a good direction. And with copper being one of those metals where it's vital for the economy that we all hope that we will aspire to one day. I think that there is school of thought. The issue, of course, is there is a very few quality scalable copper projects in the world that can be built, and often they're in environments like Chile where, let's face it, the red carpet is no longer being rolled out for overseas miners like it was in the past.
And what are your clients saying about gold? Are they frustrated with this lack of performance that we've seen this year and even last year?
Yeah, I think that the clients that we have in the portfolio understand that the gold price in dollars is not being valued using data right now. It's being valued using further out in the yield curve. So the moment inflation data is saying that in 5 years' time, the US inflation will be back down to 2%. And the Fed is at the moment saying that interest rates are going to keep going up. So if you take a contrary view on that in 5 years' time, inflation will be higher than 2%, and in 5 years' time, interest rates will be lower than 6%, i.e. down to zero, because the economy will essentially result in the Fed having to rescue it again. There's your opportunity for gold, and our clients understand this. Perhaps we can rephrase the question and say, do you think the Fed is going to blink? Because that's really what it's about. We're all hostage here to the same situation. We're all waiting for the Federal Reserve to recognise that the global economy is falling into a recession and the financialization is collapsing. Sure, they might. This might be part of the plan. We might be going into a reset. And it's interesting at the moment that the euro and the pound and the dollar are all up trading essentially at par. I'm not saying that's going to happen. What I'm saying is that we're in an interesting juncture right now. Gold is an insurance policy, and people that buy that take a longer-term view on why they hold the metal. And right now, if you're not holding dollars, you're suffering from monetary debasement, and you're questioning what money really is. Well, gold has been money for the last few thousand years. It's survived multiple periods like this through monetary debasement. And I have a feeling that we're not going to have to wait too long before we see a renaissance of gold and silver.
So there's still hope.
I think it's more than hope.
Well, Joe, that was a great discussion on gold and equity valuations, and I want to thank you for sharing your insights with us today.
No worries, Jimmy. Good to see you.
Hi, David. Thank you very much for joining us today. How are things in Toronto?
Fantastic. We're looking forward to a beautiful fall day here. It's cooling down a little bit, but it's a lovely day.
And I see you're a big Blue Jays fan.
Yeah, go Jays.
David, Agnico Eagle has a very rich history in Canada. The name Agnico is an acronym for the three metals the company focused on at one point, which is silver, nickel, and cobalt. But now the focus, of course, is on gold. And Agnico is the third largest gold producer in the world. Can you just provide us with a brief overview of Agnico, how many producing mines there are, what countries you focus on, and also what your annual production is?
Sure. As you say, Agnico started in 1957, silver mining in Cobalt, Ontario, and have been producing gold since 1972. When I started with the company in 2005, we produced around 200,000 ounces per year. It's now forecast at 3.3 million ounces this year. We continue to operate in countries that lean towards lower political risk, and obviously that's on purpose. So that's Canada, where about 75% of our production comes from, Mexico, Finland, and more recently Australia, with our merger with Kirkland Lake Gold earlier this year.
As you mentioned, you have 11 producing mines in 4 different countries, but in the interest of time, David, I just want to focus on 3 of your larger mines. That's Detour, Malartic, and also Fosterville. And I want to begin with Detour. It's currently producing approximately 700,000 ounces a year. It was acquired in 2020, and since this time, Agnico has made significant improvements at Detour, which has resulted in higher production and lower cost. Maybe you can just touch on what some of these improvements were.
Yeah, so it's actually a great case in terms of mining. I'm a mining engineer myself, and so I always appreciate what the people at the site are able to do. And everybody knows that Detour is a past producer, and when it started as a large, low-grade open pit, it really struggled. And for many, many years now, the people at site, the engineers and geologists and so on, have really made a tremendous effort to incrementally improve the operation there. It's things like drilling and blasting, higher energy blasting, just improved haulage, making sure that they get a higher payload per trip, improved fragmentation, technology improvements, autonomous and trolley assist. Things are, great ways to incrementally improve the operation. And I think Kirkland Lake Gold, prior to the acquisition, had made tremendous progress there, including finding a lot more gold, which Agnico has continued. And now Agnico is continuing on those optimization efforts. So it's really a great case of incremental improvements that have added up to being one of the largest gold mines in Canada. In fact, next year we believe it will be the largest gold producer in Canada, slightly beating out our other mine, Malartic.
And I'm glad you brought that up because, as we mentioned, it's currently producing around 700,000 ounces a year, but your projection is to move it toward 1 million ounces a year. Maybe you can just touch on how you're going to do that and also what the timeline is.
Yeah, so it's really mill expansion. We're expecting, we're about 25, 26 million tons per year right now. We think we can get to 28 million tons by 2025. In fact, that project is really ahead of schedule. The permit allows us to go to almost 33 million tons per year. And again, it's going to be a lot of these little incremental improvements and some, especially in the mill where you have to push through more rock. But again, it's improved fragmentation, changes to how they feed the crushers. We've recently been working on installing additional screens to just get the fines out of there sooner. It's, again, all these very exciting things for mining engineers. But we're very excited about Detour, and mostly because our expansion plans are supported by ever-growing mineral endowment and resource and reserves, as we've seen over the past 2 years with the exploration releases and the increases in the size of the deposit. The most recent exploration that we put out showed that it continues to the west. The pit continues to the west, but also at depth, and we think there's probably an underground operation there in the future that will be able to supplement this and drive us ultimately towards the conceptual target of 1 million ounces per year from Detour. So very exciting.
David, you also have a very active drilling campaign happening at Detour. What is your budget?
So we're spending $36 million in 2022, which is more than 10% of Agnico's total exploration budget. So a very significant amount of money there. We believe that'll get us approximately something less than 200 kilometers of drilling at the deposit in 2022. We're finalizing the budgets for 2023 right now, and we expect that there'll be a very significant amount spent in 2023 as well, because it's almost low-hanging fruit. Every drill hole we put into the west seems to extend the deposit significantly.
That's a great overview of Detour. I want to move on now and discuss another mine, Malartic. It's also one of Canada's, I guess it's currently Canada's top producing gold mine, but it's co-owned with Yamana. It produces approximately 700,000 ounces annually, of which 350,000 ounces are attributable to Agnico. But a primary driver to Malartic's future growth is the development of Odyssey. Maybe you could just expand on that. Tell us exactly what is Odyssey.
Yeah, so this was known to us and of course our partners Yamana when we purchased Osisko. We knew about the Odyssey deposits. There's a north and a south deposit. We knew about the past producing underground mine at East Malartic, but we certainly didn't know to the extent that they would grow. And then subsequently found the parallel zone of East Goldie. So this has proven to be very significant. In fact, we've announced discoveries of about 15 million ounces east of the Malartic pit. This will be extracted from underground, and just thrilled that it keeps growing and growing as well. And so Malartic will transition over the years to be Canada's largest underground gold mine after many years of being Canada's largest open pit gold mine. Very exciting.
David, another key asset in Agnico's portfolio is Fosterville, which is located in Australia, and that was acquired from the Kirkland acquisition, which closed earlier this year. Can you just provide an overview of Fosterville, touching on the production and also the all-in sustaining cost, because this is one of the elements that makes this asset truly special?
Yeah, Fosterville is a very, very interesting mine. Again, as a mining engineer, I find all the technical details fascinating. And when you run into high grade, it's like a kid in a candy shop. And certainly that's what happened at Fosterville. When Kirkland Lake Gold bought it, it was around a 5, 6, 7 gram per ton deposit. And then suddenly they started running into 30, 40, 50, 60 gram per ton in the Swan Zone. So obviously the production jumped from around 200,000 ounces per year to around 600,000 ounces per year. Agnico expects the deposit to produce around 400,000 ounces this year at cash cost less than $400 per ounce because of that high grade nature. So what's interesting to me going forward about Fosterville is that we are still encountering in our exploration some extremely high grade intersections. We haven't found it en masse the way Kirkland had found it at the Swan Zone, but there are still hints that there's more to come there. So it's a little bit of a wait and see and just keep drilling and keeping your fingers crossed. But as the operators there point out, the Australians, they say, you know, this mine's been around for quite a while. It doesn't really matter what the grade's going to do. It'll still be a profitable gold mine, but it is quite intriguing to wonder what you might get almost one day to the next. And we've, as Agnico, not having as much experience with that deposit as our friends at Kirkland Lake Gold had. It's funny around the office because the new Agnico employees, meaning the ex-Kirkland people, are saying, "Oh, don't worry about it, don't worry about it." We're saying, yeah, but that kind of volatility week to week, month to month in production is unusual and hard to budget. And that's one of the things we struggle with annually anyhow is, what is the right kind of guidance for all of our mines? But when you have one stope to another 10 times the grade, it does make it a little bit difficult to get through that budget process.
And you also have a very active drilling campaign happening at Fosterville. Maybe you can just touch on that, what your annual budget is.
Yeah, so the budget at Fosterville, it's about $35 million in 2022. So like Detour, a very, very significant piece of the spend. Again, more than 10%. And it's based on success, which is the same for all of our operations. The more you find, the more money you get.
With the acquisition of Kirkland came a lot of synergies, and maybe you can quantify these synergies and just how they're benefiting Agnico. And are they more focused on the corporate side or on the operational side, or both?
It's definitely both, but it's going to be in phases, and I think we're seeing that already, that the initial phase is obviously corporate. We did have overlap with personnel at the head offices. We had 2 head offices in downtown Toronto, so of course you don't need that. So we're actually ahead of schedule on the corporate synergies, but I think what is most exciting and what will drive us towards that $2 billion of synergies that we announced on the deal, which will be realized over approximately 10 years, are the operational synergies. And the best way to talk about that is in the Kirkland Lake camp itself in Northern Ontario, where on the western end of the camp, Kirkland Lake Gold had the Macassa gold mine, have been operating there for many years. The entire eastern side of the camp was Agnico Eagle's development and exploration properties. So when you put those together, you've got an operating team, you've got capability right there, hundreds and hundreds of employees, but also just to the north of that, you've got Kirkland Lake Gold's idled Holt Mill. So when you put the development and exploration properties together, we've got the possibility to utilize that mill. We've got the possibility to use underground development at Macassa to access an adjacent deposit owned by Agnico, which is called AK, Amalgamated Kirkland. We're already ramping towards that right now, and it'll provide us good drill platforms on our side of the boundary. Again, now it's all unified. So great opportunity because Agnico was already considering a central milling complex, and now we've got that at Macassa. We think there's some capacity at the Macassa mill, and then that idled Holt mill is really giving us opportunity to drive those synergies at the operating level much, much higher over a long period of time. But we're really happy because we're ahead of schedule already. And I think the synergies from this deal, frankly, are helping us offset the inflation that the whole industry is seeing right now. And that is definitely part of the reason Agnico has been able to fend it off maybe better than some.
David, let's move on now and discuss your balance sheet. And I just want to touch on your cash position and also liquidity and how you will allocate cash flow in the coming year. Are you going to focus on paying down debt or buybacks or dividends?
Yeah, we have an extremely conservative balance sheet. And at the end of last quarter, at the end of July, we announced we had about $1 billion in cash. So, and that's US dollars. So that's a fair chunk of change, good for a company of our size, but the most important part about the balance sheet is the EBITDA and the leverage. While we do have some debt, the net debt to EBITDA is about 0.2 times. Our debt covenants in our note agreements limit us to 3.5 times. So obviously a very clean balance sheet, getting close to that net cash position. We do budget ourselves slightly different than some of our peer companies, I understand, in that our dividend is a line item in our budgeting process. And it's just there. In fact, it's one of the first things we talk about at our big meeting every January. It's one of the first line items, and it's just flat every year. We make the assumption that it's going to be flat unless we can make a case to make it go up. And we've paid a dividend for 38 consecutive years. It's obviously very important to us, something we will continue. But this year, we've supplemented the return of capital with a buyback for the first time. And that's also quite interesting. I think the whole industry, well, maybe all industries in recent years, have turned to return of capital. And certainly there are investors out there that prefer the buyback to a dividend anyhow, partly because I think it is more tax efficient. And so we've now instituted it. The buyback is the variable portion of our return of capital. We do intend to keep that dividend stable over time, but certainly it's an interesting thing having both of those tools in the tool belt, I think, to make sure that we reward the owners of our business.
Now, I'm curious, you mentioned that you've been paying dividends for 38 years, but this is the first time you've implemented a buyback. Why is that?
Well, there's the classic argument against it, which was, gold companies trade at this major premium. And in fact, Agnico's always been viewed as one of the high quality premium gold companies out there. So normally trading closer to the top of the end of the range for the peer group. So if somebody said, why are you paying $1.50 to buy $1? You'd have to seriously consider that. Certainly the way the gold equities are trading these days, I think that argument has largely gone away. And we could fairly easily make the case that Agnico is trading below 1x NAV if you look at everything we're going to mine in the future. So it's become an easier discussion. It's certainly still there, but I really believe that it's an important message to the investors, because Agnico's overall message is that we are here to increase your exposure to gold on a per share basis. And if we can, as we have done for now decades, if we can increase production per share, all else being equal, that should lead to increased cash flow per share, free cash flow per share, dividends per share, et cetera, et cetera. And that really is the overall strategy. Why are we better than a gold bar? Why have we been better than most of our peer companies? It's because we've done it on a per share basis. And so I think the buyback actually fits in that story very well also.
I want to move the discussion now toward M&A, and one of the interesting aspects of Agnico is its M&A strategy. And earlier this year, you closed on the TMAC and also the Kirkland Lake Gold deal that we all have already discussed. But I'm curious, what are the key characteristics you and your team look at when acquiring other companies?
Yeah, I would say there is one overriding factor in everything we do, which is geologic potential. Because the easiest way, well, there's nothing easy in this business, but if there were an easy way to create value, it would be with your own drill bit. We find gold with our own drill bit for about $25 per ounce, let's say, in the exploration program. When you buy gold in the market, meaning, M&A, take over a junior or something larger, a producer, especially producers are fairly well valued by the market, usually. Not always, but usually. So you can often find yourself paying $100, $150, maybe even $200 per ounce for what that other company has found. That's a lot higher than $25 per ounce. So we always look at geologic potential. What can these things truly become? And I'm proud of our board for really sticking to that. I've been with the company for 18 years, and it is virtually the first question they ask us every single time. Okay, great. We see your big binder full of great information, but hey, geologists, stand up and tell us what this really could be. And I think we're seeing that right now come to fruition with an asset like Detour. And Detour certainly was an operating mine, but and Kirkland Lake had done a great job drilling it off. About a year ago, they put out a press release that indicated another 10 million ounces. It's just continued to grow from there. So I think our fundamental thesis has been correct, that mine probably will be operating 50 years from now, and we'll be pretty happy with the price we paid. So that is the overriding M&A strategy. Now, the other giant filter is where in the world is this asset? And you're not going to find Agnico in the deepest, darkest four corners of the planet. We just always say mining's hard enough in the parts of the planet that are more friendly towards mining or more stable in terms of rule of law, et cetera, et cetera. So again, it's not a coincidence that you find us with 75% of our gold production in Canada. Finland's certainly a lot like Canada. They like hockey as well. And while in Australia and Mexico, I don't think they're as keen on hockey, they are into sports, so we'll take them too. But also strong rule of law and centuries of prolific mining history.
Now, I'm surprised you didn't mention valuation, and my thoughts are that if a company that you want to acquire is trading at a discount to its NAV, and Agnico stock is trading at a premium, I would think that would also be a compelling argument. Is that the case?
Yeah, it's obviously true. However, that is not a driving force behind our M&A strategy. We call that the math game, and I think if you play the math game frequently, it eventually won't work out very well for you. There is usually a reason that the other assets are trading at a steep discount to NAV, and it could be that they're really just not that great. So again, you would have to go back to, is there an opportunity here? And that opportunity would usually be geologic potential. You could find many examples today of assets trading at huge discounts that could be related to what part of the world they're in. And, again, the deepest, darkest four corners, they deserve to trade at a big discount, in my opinion, because I don't think you'll be able to create decades of value in those difficult regions. So valuation obviously matters, but it's not the driving force behind what we do.
We've seen a lot of consolidation in the last couple of years, in addition to Agnico buying Kirkland Lake and Detour, and also TMAC. Barrick acquired Randgold, and shortly thereafter, Newmont acquired Goldcorp. And of course, we currently have a acquisition going on between Gold Fields and Yamana. But do you think consolidation is going to continue within the sector?
I do, and I think this is really driven by a major shift in the industry. Call it 10, 15 years ago, the resource specialist did in fact have a significant amount of money, and you know this from your career as well. There's been a major shift, and now the generalist has all the money, and the generalist does not have to buy resource stocks. They will only buy if you're running a good business, but they also require scale and liquidity. And I think that is important now and will continue to drive some M&A going forward. I would hate to be, a junior explorer right now or a single asset producer and try to get a meeting with Capital Group or Fidelity or Wellington or whoever. I'm sure that must be very difficult. So that's a major shift in the industry, and I think that's going to continue to be in the conversation for the next number of years.
And Agnico has 11 producing mines. Would you consider selling off some of your smaller operations to focus on the larger ones?
Yeah, that's a really interesting point, and one that has come up around the office in recent years, because 11 mines probably, and third largest producer in the world, I presume we now officially have a portfolio of mines. And so the right way to operate a portfolio is to continue to improve the quality of that portfolio. And because mines are a depleting asset by definition, I think it makes logical sense that at the end of a mine life, perhaps it's time to move on management time and attention to something more interesting where you could create that additional value. Call it geologic potential, where depleted resource, by the dictionary definition, doesn't have that anymore. So yeah, I think that's something we're more open to than ever before.
David, you and your team were at the Denver Gold Forum recently, and I would like to hear your views on how it was and how did it compare to previous years when the gold price might have been a little more robust.
Yeah, it was actually fine from the gold price perspective. I think most people subscribe to my thesis, which is, it's everybody. It's, we will see a peak in rates. interest rates in probably 6 to 9 months. At least we'll see the light at the end of the tunnel, I expect. And I think that'll release gold. Certainly the extreme strength of the US dollar right now is holding gold down as well. I think those things will soften over time, and people will get back to the fundamental argument, which is there's an infinite supply of paper money and there's a very limited supply of gold. So gold being priced in US dollars, I think in the medium and long term will do very well. And I think most people at Colorado Springs would agree with that, and they did agree with that. It was interesting in our meetings because I would say in every meeting, close to half of the meeting was about our acquisition of a partnership agreement with Teck on a copper mine in Mexico. So people were saying, hey, copper's not gold. What's going on here? And we explained ourselves and said, well, you know, very opportunistic situation. Teck really wanted to work with us because of our operating history in Mexico. We have an award-winning operating team in Mexico. That business on the gold side has been shrinking for years. We just haven't been able to find something of high enough quality and geologic potential for us to reinvest in. And this came along, and it's a high quality asset in a part of the world that we're absolutely thrilled to continue doing business in. So by the time we explained ourselves, I think all of the investors were saying, okay, you know, makes sense, just had to ask because copper's not gold. But the other thing I noticed at the Denver Gold Forum was virtually every big gold producer was talking about copper. So an interesting shift as we move to the electrification of the world. It actually makes a lot of sense.
David, as we wrap up, you mentioned earlier in our discussion that when you started with the company in 2005, Agnico was producing 200,000 ounces a year, and here we are, 2022, and you're doing over 3 million ounces a year. What's next for Agnico?
I think it's more of the same. Over the next couple of years, we'll be fleshing out the pipeline, giving a lot more color on the next phase of growth. We were in a meeting yesterday, in fact, talking about the phases of Agnico, going from that single asset producer at LaRonde and now internationally with 11 operations. We really believe that with our pipeline, probably with a little bit more M&A here and there, we'll be able to continue to increase the shareholders' exposure to the metal, to gold overall. But it's always got to be on a per share basis, and that's in the back of our mind. We're trying to figure that out right now, but if you look to our February guidance of next year, I expect there'll be a lot more color beyond our 3-year guidance just to talk about that pipeline. And hopefully we'll be able to describe over the next few years how we can grow from that 3.3 million ounces and certainly deliver that per share growth in all those metrics that we talked about.
Well, David, that was a great overview and a great update on Agnico, and I want to thank you for making the time today. And maybe the next time we get together, we can discuss the other 8 mines we weren't able to talk about.
Great. That'd be fantastic. Look forward to it, and really appreciate your time as well, James. That was excellent.
Thanks very much. Well, that concludes another conference, and I want to thank all the conference participants and also our corporate sponsor, Sprott Money. Be sure to check out their website, sprottmoney.com. We have some amazing conferences coming up, including a battery metals conference and also a precious metals royalty conference. So be sure to subscribe to the channel, hit the notification button so you can be kept up to date. Thank you for your support.